Good afternoon, everyone. Thank you for coming here on such a rainy day. My name is Deborah Hurst, and I'm the Dean of the Faculty of Business at Athabasca University. Thank you for joining our symposium and celebrating and engaging in the future of learning. Today we're going to be addressing the role of capital markets and what role they should play in diversifying the Alberta economy, attracting new business, strengthening existing companies, especially if that allows them to grow their business and enter new markets. So also as a special welcome to those joining us online from across Canada and around the world, either through our site or through Facebook Live. Welcome to you as well. If you want to tweet during this session, please use the hashtag #ABCapitalMarkets, all one word. We've gathered a panel of experts for you today, true leaders in the field to discuss and to take your questions. So I'd like to start off by thanking our panelists and introducing you to each one of them, although I believe they're already extremely well known. And they're also on that little card that you will find at your seat. Leo DeBaver, Chairman, Oak Point Energy, Bennett Jones LLP, C.D. Howe Institute, and former CEO of AIMCO. Dave Mowat, President, ATB Financial. Ungad Chadha, President, Capital Formation Equity Capital Markets and the TMX Group. Darren Hopkins, Director, Co-Head of Public Venture Capital Division at Richardson's GMP. Michael Mick Thompson, President, Independent Capital Partners, and Russell Kalmakoff, President, Rockmount Financial Corporation and a member of our Business Leadership Advisory Council. So welcome all of you. And I have to say thank you so much for being part of this event today and sharing your perspectives. I, for one, am greatly looking forward to learning a great deal as a result of your presentations and the Q&A session. We're trying to come at this issue from a number of perspectives and ideally develop as a result a shared understanding of the opportunities as well as provide deeper insight into the public policy gaps that may exist in our province. And of course, at Athabasca University, we ask students always to connect theory with practice. So that's a challenge for all of you today. You have to be students. We hope that our discussions will include some interesting theoretical and high-level and analytical thoughts, as well as provide tangible takeaways for all of you. Our Faculty of Business, I'd be remiss not to say, is home of Canada's largest executive MBA with roughly 900 students in population. Senior manager and executive management leaders from across all of the sectors of Canada and around the world. We're also home to approximately 13,000 undergraduate students and roughly 60 doctoral students, as well as a growing proportion of the professional leadership and management development students. I would say a national powerhouse, but then I'm biased. And amazingly, we're often better known in places like Toronto or Shanghai and Munich than we are right here in our own backyard. But today, we begin to change all of that. Earlier this year, we launched our new strategic plan, and just a few comments. It's rooted on 3 core strategic pillars. The first being outstanding student experience, and our growing reputation as the second. And the future of learning events such as this is part of what we're trying to accomplish. Our efforts to gain international accreditation with AACSB as a part of that as well. And the third is in strengthening our partnerships to industry and organizations. So you're going to be hearing a lot more from us. So before I hand over the podium to our panelists, I have one more thank you, and that is to Marg Mrazek, who's here, our interim chair of the Athabasca University Board of Governors. So thank you for joining us. I'd also like to thank our sponsors, Rockmount Financial Group, Toronto Dominion Bank, ATB, CPA Alberta, and Stantec. This event wouldn't be possible without you, so thank you very much. Now, I'm particularly thrilled to make mention of Stantec, who supports the symposium, because in many ways they model what we're about to and what we want to achieve in Alberta. Stantec began right here in Edmonton more than 60 years ago, and two of the most important milestones in their history that fueled its growth were going public on the TSX in 1994 and being listed on the New York Stock Exchange in 2005. Access to capital and the tools of public markets are critical to move an SME such as them to a world leader, which is what they are. They're now one of the top 3 design firms in the world. And again, Stantec, thank you for your support. Okay, enough for me. Let's get down to business. So I'm going to call on each of the speakers in turn, beginning with Leo DeBaver to start us off, and I'll be back up here when our next speaker is ready. Thank you.
Thanks very much.
You're welcome.
Good afternoon. I haven't spent as much time here lately as I did when I was obviously running AIMCO. And what you've also may have noticed is once you retire, the number of business cards you carry proliferates. If you're not ready for the rocking chair, you can get some interesting things done. And in fact, a lot of the comments I'm going to make today are in part due to the interaction I've had over the last year and a half with some really nice and smart young engineers. And what that has caused me to conclude is that in the financial sectors, we probably don't spend enough time looking at the technologies that we invest in. We focus on the financial engineering rather than the real engineering. And as I reflected on what I was going to say, I realized that the best I could hope for today was probably that I make you all equally unhappy. And the reason for that is that I'm going to advocate some rather dramatic changes because I feel they're needed in this society if we're going to be able to survive what we're going through right now. And I think that's necessary because the social cost of delaying any change that we need to make to remain competitive is very high. Machiavelli observed 500 years ago that trying to champion change is probably the most dangerous thing that a leader can do. And it's very simple why that is the case. He says the people who benefit from the status quo are going to resent it because it upsets their apple cart, and they typically tend to be very good at having their benefits or their interests enshrined in laws and regulations. And the people that you're trying to benefit haven't quite figured out yet what that benefit will be, and human nature being what it is, they're worried that they don't truly understand what you're trying to do. And that makes it hard to champion change, even though the logic may be impeccable. Now, when you're coming up with solutions, and I'm playing the geeky economist this afternoon because I had a fair idea where the other members of the panel were going to come from. If you're coming up with solutions, it helps to be clear about the problem you're trying to solve. And I strongly believe that the problem we're facing is that we're in an era of accelerating technological change across the economy, and that we somehow missed the fact that energy is, as always, right in the middle of that kind of change. It was reasonably clear by 2014 that falling oil and gas prices had little to do with Middle Eastern politics and everything with rising reserves because of improving exploration technology and the spread of fracking and horizontal drilling and the resulting production of oil and gas in the United States. And I think it's also reasonably clear. Can you hear me? Because the volume seems to be...
Yeah.
It's okay?
Yeah.
All right. I guess the other factor is that conservation and alternative energy, the falling cost of alternative energy impacted the gap between demand and supply. And so what we end up with in the short run is too much supply, and even in the long run, I think will. And so that's why I believe that going forward, it's very likely that any recovery in oil and gas prices will be limited, and that will not go back to what we had between 1990 and 2010, where we had a lot of zigs and zags, but at the end of the game, the price would keep on increasing. So when we're thinking about diversification, we have to realize that the game has changed. We can't get there by simply riding the commodity cycle. We have to improve the technology, and it's unrealistic to devise a diversification strategy that revolves around making oil and gas irrelevant to the economy. I mean, it's true from a fiscal point of view that oil and gas should be less of a part of the budget for the government, but that's a separate issue. When you talk about technology and how we run the private sector, we need that more efficient technology. I also believe, and a lot of people will disagree with it, that in the next 5 to 10 years, someone, maybe a number of someones, will come up with a way to deal with CO2. And what I mean by that is that I've already seen a number of technologies that when you take two processes and blend them, you can deal with CO2 and basically tie it up either in petrochemicals or in some kind of fuel. But the bottom line is that to get there, to get to a better technology that is both environmentally friendly and economically more productive, you have to make some very rapid investments. And right now, we're just not positioned for that, because the early adopters of new technologies tend to be small companies, and they tend to be undercapitalized. Because when you're a big international oil and gas company, you've got other options, and Alberta may not be on the top of your hit parade when it comes to investing in your next project. And that brings up another issue. The private sector may not be able to supply the capital, the private sector meaning the corporate sector, that we need to get this done. Now, that's always been the case. When you go back in history, all the significant changes in technology have initially been driven with assistance from government. Now, in the US, you got the Defense Department, the Industry Department. In Alberta, we had AOSTRA. And I would argue that right now we probably need another AOSTRA, slightly different in composition, or an AOSTRA on steroids, as I mentioned earlier. And we also need a better balance between real engineering and financial engineering. Financial engineers tend to focus about capital composition. Real engineers used to think that if you build it bigger, it makes it more economical. It turns out that the economies of scale of technology along those lines don't work, that the economies of scale come from fabrication and from being very efficient in putting stuff together rather than from making them bigger. Because when you make them bigger, you have to put them together in situ, and you have to work with large labor camps in inhospitable conditions, and any problem you run into tends to be big. You know, we've got one project on the way that was supposed to cost $4 billion. It may cost $9 billion when we're all through, and that kind of thing is very common in energy technology. Now, energy sector hasn't had a great track record in terms of dealing with the environmental sensitivities of its clients, and as I already pointed out, I think that doesn't need to be the case. I firmly believe we can achieve the profitable and the desirable in that case. And it reminds me a little bit of, or a lot actually, of what happened in the 70s when people opposed recycling of various commodities because it was supposedly costing them more to recycle than to dispose, and then when they put their minds to it, they found out that that was not the case. Now, where's the money going to come up to do all of this? Since the social opportunity cost of delaying is so high, I think we have to find a way to bring some public money into this capital. Now, the question is always, well, we got pools of long-term capital that should be investing in this, and they're not. I mean, there's only one pension fund in Canada, pension funds being pension endowment funds being the long-term capital providers. There's only one pension fund that invests in this place, this kind of thing. And what we need is new vehicles that are smaller in nature outside of these agencies, because what tends to happen in pension funds, they don't want to directly invest in anything that's small. So the best alternative to that is an initiative that I tried to work out a few years ago called Emergex, where you pool some private and public capital and do it outside of the pension fund directly. Now, why are pension funds not interested? Well, the returns on this kind of activity has been very low in Canada, and the main reason for that is that once you get to the end of a development cycle, there's nobody to take your place. So we need commercialization capital. Pension funds, endowment funds should be in a position to provide that, and I think that will make it go around. Now, I'm being maybe overly dramatic, but think of what's going to happen 20 years from now when the next generation is 20 years old. They're going to ask us and say, well, where were you when Alberta was in its economic funk? What did you do to make the situation better? Now, the answer that I would like to see come out of that is to say, you know, we were in a bad spot, but we got our act together. We came up with some ideas. We tried a whole bunch of things, and a lot of them didn't work, and we expected that, and that was okay. But the ideas that did work are the ones that provide you with the high standard of living you have today. That's the kind of thing I hope we can get our minds around, and that's what I hope we will be able to accomplish. Thanks very much.
Dave?
Here we go. Did you call yourself a geeky economist?
Yeah, I think I did.
You did. He was a rock star. He did a lot of things for Alberta. He's very, very humble today. So what I thought I would kind of work on here is, go forward, Dave, is there's lots of expertise on this panel on capital markets. I'm kind of the believer that GDP follows brains. And if this was a different setting and we were talking about post-secondary funding, I'd be talking about pouring money into educating Albertans and making us as smart as we possibly can. But if you assume we've got that, I think the next piece is, and you've got a little chart in front of you, is to get funding to those brains. And ultimately, there's a lot of steps along the way. And if you talk to venture capitalists or even talk to people who do IPOs, they'll kind of talk about, well, there's no good deals, we don't have the deal flow. And, you know, I think there's lots of times it's not that the deals aren't there, it's they're just not at the right stage. They haven't scaled or they haven't shown the opportunity that people would be interested in risking more formal investment into. So I think there's a continuum here that if you look at it more closely, I think there's many, many tools to take us to the spot where people can actually utilize the capital markets. And I think something Leo said is we shouldn't forget is the world is changing very rapidly, and you know, we're going to talk out here about capital markets that have been around for a long time. But I just wanted to walk you through a couple of things. And we kind of poo-hoo some of this stuff. Crowdfunding is just something on the internet. 4 years ago, there was $1 billion in North America that was raised through crowdfunding. The next year there was $2 billion. Last year there was $5 billion. And this year we'll finish at around $10 billion that's raised in crowdfunding. So I think it's, you know, all the conventional ideas that we have on how to raise money from Weird Uncle Harold, you know, crowdfunding is increasingly funding complicated businesses, and it's starting to creep up in the size of deals that are actually done. Just to give you a sense, if you look at angel investors, we know they've been around for a long time. They were about $25 billion last year in North America. So crowdfunding in itself is coming up to catch angel investors. And I think one of the things we talk about is kind of a dearth of venture capital investment here in Alberta. I think that's quite understated because we have, I think, pound for pound, I can't prove it with numbers, but here in Alberta we have a lot of wealth that's concentrated in the hands of risk takers. So we have a lot of bootstrapping that goes on in this province, and a lot of people that underrate some of the initial stages of business. And so Alberta is in pretty good shape in terms of angel investing. The one that's interesting is crowd lending, and you're thinking here we're supposed to be talking about equity and capital markets, but the crowd lending is a very accessible. It doesn't have the banks are banks, and we all wear white shirts and narrow ties and things like that. The crowd is much more. It's a loan and it has a return to it, but it's much more like equity than a bank loan would ever look like. And there the numbers are even more startling. Is that the year before last we did $10 billion in crowd lending in North America. This year, the year that just finished, we did $25 billion in crowd lending. And I think sometimes these things creep up. I mean, I'm a banker. I've been doing this for 35 years, and I think of banks as branches and loans and things like that. But this is real live money, and this is a lot of money coming into the market. And I think sometimes we don't see these sources for what they are. Private equity is one of the things that, and it just happens we're looking at it, is private equity, and I'll talk a little bit in larger deals. I think there's a market to go down. We're trying to work in the $500,000 to $5 million mark in private equity, which gives companies the ability to scale up to the point that perhaps they can have access to the public markets. And so that's kind of unique to Alberta, and it kind of works off the fact we have about 100,000 businesses that deal with us in Alberta. So we have the deal flow that nobody else has that's in the private equity business, so we can still make money doing the smaller deals, which the larger investors don't like to do. Accelerators is another thing in Canada. They don't have a great name. There's not tons of successes that have come out of them. In California, in Silicon Valley, you have to apply to get into the accelerators. You have to be sponsored to get in. It's a huge feat if you can get in. But I think one of the things we need to think about accelerators is one of the things you hear a lot about in the Boston area and in Silicon Valley is you get that convergence of brains and people, and they might not be working in your business, but you're working right beside them. And there's just this interplay of, like Leo said, he's been hanging around with young engineers, is you just start to get a community of knowledge going. And I think we kind of underestimate, that's kind of what we're missing a little bit in Alberta, is that kind of hub of smart people working on tough problems. And I think accelerators are something that can bring those people together. And we have some examples here, but I think there's things that we can support even more. Mezzanine debt is just another, I'm going to skip over that one. Private equity, one of the things that Leo kind of touched very lightly on is what he was trying to do is take some of the capital out of the big pension plans and put it into something that's a little willing to take more risk. And I think there's huge opportunity to do that in the marketplace. And then the next piece is the capital markets, and you're going to hear from people on this score for sure. I think one of the things, we're a 30% owner in a small little investment banking firm, a boutique firm here in Alberta, Alticorp. But, I think the marketplace desperately needs that independence. There's nothing wrong with the big houses owned by the banks. They have scale, they have big balance sheets, they have the ability to give us scale in the marketplace. But an awful lot of the little companies were started in some of these small investment houses that were prepared to take a risk. And you're going to hear, I'm not going to tromp on their grass, you're going to hear from them. It's tough out there right now, and so we have invested in one of them, so we're simply one of many. But there are some great players. Alberta's famous with Peters & Co. and First Energy and others that have come before us. And ultimately, what would the world be without banks? But, this continuum, it's about creating, it's finding ways to get equity. And then once you got equity, ultimately you're trying to create leverage in your business to, so I think as banks we have a role to be, we're in business to make money, we're not in business to take equity risks. But just like I said at the beginning, I think GDP follows brains, and I think we've dumbed down banking a little bit, and we're kind of into some boxes that we have formulas, and everybody's letter of offer or everybody's loan kind of looks exactly the same as the other ones. And I think there's an opportunity to use a little more brain power in banking to support the businesses that are coming through. And I don't think it's to take tons more risk, but what it is like bankers who don't understand stuff say no. It's just we're trained to do that. And you have to work harder to understand things. So I think that same way we need to encourage and get the smartest people we can in business. I think there's a little room to grow here for us banks in terms of getting people who really understand the businesses that we're looking at, and we have the ability to bring them up and through the system. I'll leave it at that. Thank you very much.
Thank you. Thanks, Dave. Thank you. We were joking, I guess I have a mic on me. We were joking earlier about the bankers showering in cash and that type of thing. So as I was sitting in the middle of the semicircle there, I was thinking I've got cash to my left, the platform in the middle, and the deal guys on the left. So just an interesting thought there on the circle of innovation and of capital formation. So it's my great pleasure to be here today. On the theme of diversifying Alberta's economy, there are a number of things that I thought I'd start off with just at the high level, the provincial level, and then get into what kind of role TMX and TSX Venture have played and can play in the future, and then how you all can help that be successful. Obviously, some very tough times in the province right now, and not in the country in general, but there are definitely headwinds. The theme of diversification is not new. Premier Notley mentioned it, I think, last week in her speech as sort of the number 2 bullet in what she had to say. If you go around the world, you talk to people in Norway, they'll tell you about diversification, and hopefully they don't go nana nana boo boo. We did it earlier, and you guys should have done it when we did it. But it's a very important topic. The other thing that Premier Notley mentioned was just the tightening of budgets, left, right, and center, public money. As Leo said earlier, trying to get public money into some of these initiatives is probably tougher than it's been in the past. So where does it all lead us? How do you get to, what are the needs of the province? And so if you step back, it seems to be risk capital, and capital generally, and diversification. So if you think about those 2 needs that we need here in Alberta, in my mind, one of the agents that can play a role in that, along with the other folks on the panel here, is enter to the stage Canada's capital markets. And if you take a minute and look across the Venture Exchange, the Toronto Stock Exchange, TSX Private Markets, these are all platforms that we've developed, and it takes a whole ecosystem, it takes a village, so to speak, to get an exchange really humming in whatever sector, whether it's oil and gas, or it's hard rock mining, or it's now where we're aiming in more innovation type sectors. So I think there's a real opportunity here for these platforms to be put more front and center as an agent in the solution for diversification and raising capital. There were slides earlier, I think perhaps in David's deck, or maybe it's just part of the university slides here, which talk about this ecosystem of players. And my general comment across angels, private equity, VC, crowdfunding, you name it, is our view at TMX is these are complementary and supplemental financing sources, not substitutional. We really want to make sure people understand, owner managers, entrepreneurs, those who are starting businesses that are working on whatever innovation it may be, whether it's capturing the CO2, as Leo said, or what have you, they don't think of it as a binary door. Door A is public markets and door B is the antithesis of public markets. Most of our clients, and many of our clients rather, have a blended capital structure. They have had a varied capital pathway in terms of what they've raised. Typically, debt's not usually involved at the venture side of the market, but we're seeing more and more a convergence across all those different ways of raising capital. So let's talk about Alberta in terms of where its utilization rate is of Canada's capital markets. Right now, out of 3,200 public companies in Canada that are listed on the only exchange I recognize, which is Toronto Stock Exchange and TSX Venture. There might be the odd competitor, but those are the two that I recognize that pay my salary, by the way, full disclosure. 12%, so 370 companies are headquartered in Alberta out of the 32. To put this in context, you've got BC at 30%, Ontario at 40%. So, okay, you say, okay, yeah, I kind of see that number. I sort of see where it is. Oil and gas markets down, maybe that makes sense. Put another number out there for you that if Alberta's 12, actually 11.6, international corporations are at 8. So that means companies and innovations and growth companies from around the world are using the two markets as a platform to raise capital, wherever that capital comes from, whether it comes from these folks up here, whether it comes from Canadian investors or international investors, 8%. So I think there's an opportunity there to punch in higher based on Alberta's weight class, if you want to use boxing terms, and also with what we have ahead of us in terms of what we're trying to accomplish. In terms of what are we trying to accomplish? Economic growth, GDP, jobs. How do you get there? You need smart minds, innovation, more patents, more IP. And how are you going to get that? Well, you need capital formation. You need a place where you can get the dollars to match up with those investment opportunities and those business plans. A few things just specifically on the venture market, the TSX Venture Exchange. You know, this platform goes back over 100 years, probably over 110 years. Obviously, its roots are in hard rock and petroleum engineering and mining. And we've had a very tough 4 or 5 year stretch here, and some of my colleagues will talk about that, I'm sure, as well. But we are seeing some really good signs of life in the market, and I encourage you, when you're talking to other people and socializing at cocktail parties or what have you about the next business idea or university spin-out, you recognize that this market has an opportunity to really come back, and it's already starting to demonstrate some very good numbers. So I won't ply you with so many percentages, but I will throw a few out there that the index for that market is the fastest growing index in the world right now. It's up 49%. The market cap or value of all those companies aggregated year over year is up 46%. The new listings flows, whether coming from international or from domestic companies tapping the market, is up 16%. The capital raised on the platform is up 11%. Number of financings, because again, when you think about the venture exchange, we're not talking about an IPO. We're not talking about 100 million or what have you. We're actually talking about pico cap, micro cap companies where they might be pre-revenue, you might be going public raising 2 or 3 million or less. So the financings are up 26% by number. Trading activities, however you measure it on the market, is up. Now, I think you have to look at it. Things are up when you've been beaten so badly that the percentages sound better than the actual numbers. There's no question we're coming off a very big bottom, but I wanted to have a bit of good news around what we think is hopefully, for lack of a better term, the TSN turning point here for that public market. So what are we doing as owners and operators of the exchange, TMX Group? What are we doing to move this along on the diversification side and then on the access to capital side? So on the diversification side, we have spent and continue to spend and will spend a lot of our business development dollars and efforts working with the groups in the province, from the Banff Venture Forum to the Ernst & Young Awards, to the Rainforest Summit that they have in Banff, our own roadshow that we do called TSX Ignite, which is all about helping build great Canadian companies, whether they go public or not. We've had 4 events in the province already. We've been holding alternative financing series conferences for owner managers and entrepreneurs that we talk very little about ourselves. We actually don't even have a module on public markets. We just bring together the folks that you see in those honeycomb slides to talk about alternative sources. And we do that as a service to prospective and current companies. So there's a lot of things that we're trying to do to focus in on that innovation. And that's right in our, in our investor deck for TMX Group. It's right in our vision statement. It's right in our strategy. It's very important. And it obviously ties in not only for Alberta and TMX, it ties into Prime Minister Trudeau, Minister Baines, the Innovation Minister, and what their agenda is. So the trade winds are all blowing in the right direction around innovation. A couple of quick things. I don't know how I'm doing for time. Am I okay? Oh, I got a bit of time. 20 seconds. I'll have to go a little quickly. In terms of if we're a platform to raise capital, how do you do that? You've always got to balance investor protection and trust so that people come and invest in the market with great companies. So there are a lot of things that are, I wouldn't say broken, that are damaged in the model, and we have to really work on resuscitating them. One of the ones is, as the previous speaker, as Dave mentioned, the independent boutique dealer, the small broker dealer, investment bank, whatever you want to call it, that takes that risk capital and has the clientele and develops the clientele who are willing to put those $20,000, $50,000 investments, and they aggregate up to $2, $3, $5, and $8 million deals. They are suffering, whether they're suffering from a concentration of bigger players that are beating them, or the regulation perhaps is not bespoke enough to support the new environment that these dealers are in. This is something that TMX is looking very closely at, and we've actually struck a innovation roundtable, of which there are many very prominent folks on. Leo, I believe your successor, Kevin, I'm forgetting Kevin's last name, which is really, thank you, Jimilin, CEO of AIMCO, has given his time, and he's an official member of our Innovation Roundtable as well. So we have a very big focus on that, and we're not afraid to break some glass and make some very challenging recommendations coming out of the paper. That'll be in the roundtable report, will be out in first quarter of 2017. Other issues around pension funds and other asset managers, and are they playing in this asset class? If it's so important for the future of the economy and the jobs and the patents, then is it okay for us to just stay quiet when other pools of capital are not participating? So we have to look at that broadly. These institutions need to think about the long-term needs of their annuitants, their pensioners. It's good that they invest in canals and docks and ports around the world, but there's also other things to debate. So we're very focused on that as well. And with that, I guess in a parting word would really just be, what can you do? It is a market. Market's driven on participants and people. It goes off the psychology and the mood of people, and the mood of people to take some risk, take some thoughtful risk. Our job at TMX is to extract regulatory risk and where we can, fraud risk, and leave you with the business risk. But you have to take some risk to get the rewards. So with that, thank you for your time.
Okay, now the bankers portion of the panel is done. It's time for the street fighters portion of the panel. Right? Before I speak, I always issue a disclaimer that my employer asked me, and you'll probably see why at some point, that these opinions are mine and not necessarily theirs. They also make me issue that disclaimer at the pumpkin carving competition at our office also, so they do it across the board. Thanks very much, Russ, for inviting me. Russ has single-handedly brought the issue of the capital markets in Canada to the forefront over the last year and a half. He's also been a great help in lobbying against the National Securities Regulator, which I'm very happy to say that the previous Alberta government and the current Alberta government have stood up and said no, and have joined with Quebec in fighting against the National Securities Regulator. Though it would be terrible to see the brain trust of this province be moved to Ontario, where a national securities regulator would be headquartered. So why don't I get going here? So before they sent me my unsolicited refund from Dale Carnegie course that I took, I did learn that you always start with a joke. And so as it relates to the public venture capital market in Canada, and Dale, I quote Ross Johnson, who was the head of RJR Nabisco, and when he joined Nabisco with RJR Reynolds, he went to his first board meeting and they said, we've just been moved out of first position with our #1 cigarette. We've been there for 100 years, but don't worry about it, Ross. It'll all take care of itself. You know, it's nothing to worry about. And Ross Johnson said it reminded him of the story of the prize fighter that goes back to his corner and he's got a broken nose and a bloody mouth and a black eye, and he says to his cornerman, don't worry, he's not laying a glove on me. And the cornerman says, well, you better keep an eye on the referee because somebody's kicking the crap out of you. And so that's how, you know, I'll get to how it relates to the public venture capital markets. If you find yourself at some point asking me, where is he going with this? Just give me some latitude, and I promise I will get there. I am in a crowded theater, so I will yell fire at some point during this, right? The Alberta in Canada has an insatiable need for capital, and the capital has largely fled this country and this province. And the issue with that is that capital feeds itself into the economy. The economy is made up of small and medium enterprises who are the lifeblood of this country, who create new jobs, who create new business, create technology, and grow. And right now, that cycle has been broken, and it's a significant issue. I've lived and breathed the capital markets in this country for the last 20 plus years on the small capital side of it. I've taken 110 companies public over those 20 years, and I'm on the front line of it. And so I do get a little bit passionate about the state of this industry. So my goal today is to shock people into action, because I'd like to spend at least another 20 years in this industry if possible. When I was in MBA school, I read a book. I read a lot of books, but I read a book that stuck with me. And the book was called The Age of Unreason, and it says, change only happens at the hands of the unreasonable man. And so today, I'll try to be a little bit unreasonable, I guess. If you were, and Angad, I'm sorry, but I'm going to take a shot at some of your predecessors.
I got body vest.
Angad and I are buddies. He can long drive me on the golf course. But if you were McDonald's, the board of director of McDonald's, and your president came to you and said, our sales have gone from 11 billion to 3 billion over the period of the last 5 years, what would you do? I think it's pretty clear what you would do. What did the TSX do? They really did, by and large, nothing. What did the federal and provincial governments do? By and large, nothing. Since 2010, where there was $11 billion raised on the TSX Venture Exchange, to this year, we're below $3 billion. That's $8 billion has evaporated from the public venture capital markets in Canada, and there is no talk about it. There is nothing mentioned. That is money that goes into this economy, this town, this university, all universities. The philanthropists who make money, they donate it to universities, hospitals, and so on. That money has evaporated, and by and large, there has been nothing done over the last 6 years since this money started to evaporate. If you were the board of Athabasca University and your enrollment went from 2,200 to 1,600 students over a 5-year period, what would you do? Well, the TSX and the TSXV really haven't done much. What did the federal and provincial governments do? Not much. The number of listings on the TSX Venture has gone from 2,200 to 1,600 over that time period. That's problematic. That's 600 public companies that are not raising money, that are not creating jobs in this province and the other provinces. If you owned the Oilers, and your winning percentage dropped by 2/3 over a 5-year period, when the Flames are now setting club record for wins. Now, I know that's far-fetched. But what did the TSX and the TSXV do? They did nothing. The TSXV index is 700 to 800 right now versus 2,700 back in 2010 period. The TSX, the Dow Jones, NASDAQ are at all-time records, and we're still mired at 1/3 of where we were 6 years ago. That's a problem. If you were the Alberta Farmers Association, the government said no more Alberta beef in Canadian restaurants, what would you do? What did the TSX and TSXV do? They did nothing when there was the elimination of income trusts. We saw the number of junior oil and gas companies go from over 300 to less than 30 today. And yes, the price of oil has something to do with that, and technology has something to do with it. But the biggest kick came when the income trusts were eliminated, because that was the lifeblood. These companies grew from 0 to 1,000 barrels a day. They sold, and that capital was redeployed back into the market. And that's how you end up with biotech companies in Alberta. That's how you end up with public real estate companies in Alberta, because the guy who makes, or the girl who makes a $100,000 profit, 50 goes back into oil and gas, the other 50 goes into all these other things, and that diversifies our economy. And that's what was happening, and that's what's not happening now. So on and on. The elimination of independent brokerage firms, which we talked about earlier. I think Mike, maybe he has it in his stats, but there was 37, 40, 50 independent brokerage firms when I started in the business. We're down to 6 or 7 now. The industry is dominated by the big 5 Canadian banks, and they have eliminated their ability, for the most part, for their brokers to participate in the public venture capital markets, being the TSXV. It's just not on their compliance radar. They prefer that their brokers do not recommend stocks on the exchange. And that's problematic because that is where the capital came from. The independent brokerage firms were the lifeblood of the TSX Venture Exchange for all these years. TSX Venture, of course, was formerly the Vancouver Stock Exchange and the Alberta Stock Exchange. Those exchanges were created by entrepreneurs because their needs were not being met by the Toronto Stock Exchange circa 70, 80, 90 years ago. And that's why the exchange exists today, because the needs are still not being met. I've heard that capital gains is on the docket to possibly be changed to a 75% inclusion rate instead of 50%, which would be, again, extremely detrimental to the public capital markets in Canada. When you add in the accounting standards of IFRS, which were added in a number of years ago, created problems for a lot of the junior companies. Just the cost of compliance and filing accounting statements came close to bankrupting a lot of companies and has made their cost of capital prohibitive. So what does the TSX and the governments do? And I think I've said this before. Well, they've said it's just a cycle. Hopefully things will get better, just like the old days, is what I was repeatedly told for years. And I go back to Ross Johnson again. And in my view, what was the TSXV going in the future? Well, Ross said an accountant is a man who puts his head in the past and backs his ass into the future. And I kind of felt that's what was going on at the exchange level for the last few years. At lunch today, I had a great conversation with Ungad, and he's told me the changes that are underway. And and if you carry through with those changes, well, that warms my heart because they're long overdue, and I'm quite enthused by the changes that have been mentioned at lunch today. Tomatoes versus public venture capital. Warren Buffett, when he bought Heinz, they closed a plant in Leamington, Ontario, a tomato canning factory that put 250 jobs out, people out of work. What happened? It made the front page of the National Post. Public venture capital is almost dead in this country. $8 billion is evaporated, and nobody's talking about it, versus 250 jobs lost in Ontario at a tomato canning factory. This is the problem, is that this is just not out, the media is not covering it, and we need our governments, our local governments, our securities commissions, our regulators to get on this and help save this market. The ugly reality, like I said, we've gone from 11 billion to 3 billion, 2,200 to 1,600, 2,700 to 700. We are a resource economy in this country and in this province. We have the elimination of income trusts. We have capital gains exemption possibly changing. We're eliminating independent brokerage firms at a record pace. We've lost a generation of stockbrokers that participated in this market. It's gone. I'm a dinosaur. Mike Thompson hired me 22 years ago. So if I'm a dinosaur, what does that make Mike when he hired me, right? But there are no young guys on this panel, and that's not the fault of any of the panels, because there are no young guys in this industry anymore. And young guys, young girls, that's a problem. It's a significant problem because there isn't that mindset to invest in the public venture capital markets, to be an entrepreneur, to raise money. It just has evaporated. I think we're alienated from the United States and getting capital from the United States into Canada. We have the biggest capital market in the world right next door to us, and we do not do anything to tap that market on the public venture capital side of it. Federal governments care more about tomatoes than they do about the public venture capital markets estimation. Universities, by and large, are nowhere in Canada, in the Canadian capital markets, except for, this is the first time I've been asked to speak in quite a few years by a university, and it's fantastic that Athabasca University is paying attention to this. But we have the JCP program, which was invented in Alberta, special warrants, income trusts. These are almost a course that could be taught at a university and bring the millennials back into understanding the public venture capital markets in Canada. We have unfriendly capital markets in Canada right now. We have high taxation, we have high labor, except for in this province, we have high electricity power costs. We have IFRS regulations. We are over-regulated from the regulatory standpoint, from the different layers of regulation that go on this country in our industry. It's a problem. I'll finish up quickly here. I see the red lights flashing at me. Now what? Well, first of all, the cycle of capital is broken. So as I spoke about earlier, when you have somebody, people don't generally invest their wages in venture capital. They invest their capital. And so when you have a win on capital, you reinvest that. And the wheel keeps going round and round and round, and it spins off all kinds of capital and other business. So that wheel's broken right now. What does this mean for Alberta? It means $11 billion to $3 billion. It means the hotels, car dealerships, liquor stores, dentists, all of their business has gone down. There's no new investors, no new ideas, no new businesses equals less capital, less small, medium enterprises, and I told you I'd get there, less diversification in the economy. And that's where we are right now. In my mind, I think there has to be something done with capital gains taxes in this country to deal with public venture capital. We have to address the consolidating industry. The industry that's being consolidated by banks. Government funds, by and large, do not work when it's put into venture capital. I mentioned Gaynor's name in this town. I mentioned the MagCan name in Calgary. And we understand what happens when the government gets in the business of venture capital. We need to create a capital-friendly environment in this country and in this province. Capital goes where it can be efficient and where it gets a return. Capital does not have to come to Alberta, and we have to make an environment where capital is welcomed in this province. I think there's possibly an answer at some point, maybe with ATB and Canadian Western Bank, joining with the independent brokerage firms and fighting against the big banks in Toronto and providing a one-stop shop for venture capitalists, for public venture capital, where they can get their banking, where they can get their capital markets, all the same place. And the National Securities Regulator, well, we need to continue to fight the good fight and push back against this national regulator because it is horrific for this province should it happen. This province created the Junior Capital Pool program 27 years ago. It took Ontario 17 years to adopt that program. We don't have that long to wait in the public venture capital markets. We're a dynamic economy here. We reinvent ourselves all the time. If we pass our securities regulation onto Ontario, we are doomed on the public venture capital markets. So with that happy note, I will pass it on to Mike.
Well, I can tell you I'm a bit of a different character. I've been called lots of things in my life, but never a dinosaur. And I would suggest that the rumors of my demise are greatly exaggerated. I am, however, despite the white shirt and the skinny tie, quite a different beast than what you've heard from today. And, I feel like the odd person out here because Leo greatly helped while at AIMCO to earn everybody in the province of Alberta a lot of money. He's probably a guy that doesn't get the proper credit for it. Dave with ATB, you saw those ads on TV. It's fabulous. They cater to entrepreneurs. He's hired a fellow that I used to work with in the investment banking business to help interact, a dating service, if you will. So they're taking a different point of view. UNGAD certainly has done a lot with the TSX and the TMX group, this innovation subcommittee and roundtable. We're hoping that that's going to do great things. So how am I different? I'm different in the sense that I eat what I catch. And I haven't been employed in about the last 15 years. Went to a golf tournament in the summer and someone said, why do I do that? I said, because no one else would employ me. I think the real reason I do that is because I started off as a lawyer. And in my book, anything doing this is better now. So I have a much different tact. And I'm going to ask for some audience participation because one of the great things about doing this, and thank you very much, Deborah and your staff, is what is a diversified economy? So, of course, I ran to the internet last night, and if you can indulge me for a minute, a diversified economy is an economy that has a number of different revenue streams and provides nations with the ability for sustainable growth because there's not a reliance on one particular type of revenue. So with that, I'd like to poll the audience. Our biggest industry is energy and petroleum at about 18 or 19%. How many people, by a show of the right hand, are in the energy and petroleum business? Okay, I think I saw 5 hands. Financial services and real estate sector, show of hands. Okay, so I'm glad to see that because that makes up about 40% of the Alberta economy. And one of the things that I'm going to castigate my speakers for today is I think they took too narrow of a view of capital. Okay, we talked about bankers bathing or showering in money. We've all seen the movies where the people throw up the big wads of money. But capital is intellectual capital as well. And when you look at this paradigm here that Russ has brought up, the innovation financing continuum, we've heard a fair bit of doom and gloom, but I'll tell you, there has never been a better time to be an entrepreneur. Okay, and the reason I say that is that the federal government in its innovation plans now is pouring $400 million into essentially being an entrepreneur. And we need more entrepreneurs because when you look at the panel members here, they are very powerful and very good at what they do, but they are just a conduit. Okay? Without the entrepreneurs, without the hardworking people using their services, buying their stocks, helping diversify the economy, we're really nothing. So again, angels, there's more angels than there ever been. I mean, I don't know if you've done this, but you can go to the National Angel Capital Organization over a 3-day period and meet just about everyone in the angel community. It's a very concentrated group of people in Canada. I don't know about the other panel members, but my email will be on one of those cards. I'm happy to share information, and I do believe in giving back, not only charity in that, but giving back in the financial world. Incubators, accelerators, never been more. I mean, every time you open the page, there's another incubator or accelerator. We talk about the funds and the venture capital funds. The federal government is about to pour, I think, approximately $400 million into that. So what is the disconnect? The disconnect is, and Darren has implored you in one sense to get out and ask to make change in that. I think the real disconnect is we're not fostering an entrepreneurial culture in Canada to the extent we could. I certainly applaud Deborah and her staff and what they're doing. They're effectively, as I understand it, and I want to find more about it, an entrepreneurial MBA. So for those who have been laid off, those who have had to change jobs, I'm empathetic. I've been there, I've been fired twice. It's never fun. You know, 2 people ask you to come into a room. Never do 2 people ask you to come in a room, except when you're getting fired. And in a sense, it's a great precursor, right? So I really think that this is an excellent time, given the incubators, given the accelerators, given the universities, given who's out there, given people who will give you your time to think outside the box. And thinking about outside the box is creating those alternative revenue streams. And you know, the life of an entrepreneur, it's very different. This week I was in Toronto, flew back to Calgary, went to Vancouver, flew back. I'm in Edmonton. I'll be in Toronto another week. And I see a diverse set of people. I saw a securities dealer in Toronto that wants to use one of my financing vehicles, public companies. I'm a director of 4 of them, to monetize a mining asset. I also got together with a group of entrepreneurs that were thinking about creating a new company. I got together with Peter Paul Van Hoken, a front funder. And if you haven't looked at Front Funder, you should. Front Funder is a equity crowdfunding site. It's the first of its kind in Canada. It's got an electronic backbone. It took a Danish guy to come over here and do it. They are financing some neat things, everything from microbreweries to a bank, a new form of bank, to a new ride-sharing service. And I would say why, you know, there's a lot of doom and gloom going around. This is a time to change. This is a time to work for yourself. There's government loans, there's government programs. Get out there and make a difference. And again, with the audience participation, can I take a show of hands who is above the age of 35 here? Okay, under the age of 35? Okay, interestingly enough, it's in the minority. Again, the factoids you learn, Alberta has more people under the age of 35 than anywhere else in Canada. The other interesting thing about Alberta I learned, 2/3 of the people under 35 in Alberta, or sorry, 2/3 of the people in Alberta have more than post-secondary education. So in terms of lowest median age, best education, Alberta's #1. So again, think about intellectual capital and think about what you can do. And the problem that's been cited in large part today is that people don't want to take risks. Okay, they don't want to invest in venture stocks. Show of hands again, how many people invest in stocks? Okay, raise your right hand. How many of you people invest in energy and petroleum stocks? Okay, how many invest in stocks on the TSX Venture Exchange? Okay, good. I'm glad to see it's more than I thought. So as you look, if I asked you to look at the person on your right, look at the person on your left, that's probably a person that's going to employ you or your sons or daughters. So what I would strongly suggest you do is take advantage of the ecosystem that's out there. Yes, we can make it better. There's never been a better time to be an entrepreneur. There's never been a better, more exciting time to work for yourself. Think about your children, think about your grandchildren, think about your friends and the person beside you, and get out there and create. Thank you.
Thank you, Deborah. So this is supposed to be a wrap-up overview, and it might be redundant. Please excuse that. We all know our biggest challenge is to diversify the economy. This will come through technology commercialization, beginning with step-outs from our basic industries. The ideal outcome is to develop local companies that remain in Alberta. The entrepreneurs are less likely to sell out if they have the tools of the capital market at their disposal. This includes programs like the Capital Pool Company and junior exchanges like the TSX Venture, and there is another, the Canadian Securities Exchange. Investment banking support is a critical part of this, and at the small and medium level, this service comes from the junior independent investment dealers. It would be nice if the major banks came down market into this realm, but they don't. Now, we touched on Stantec. I got to repeat, because they're our sponsor, but they're a poster boy of what can happen here. Once upon a time, there was a couple of engineers and architects that got together and backed into a public vehicle. They built it to a major company because they had access to the capital markets. Today, they're $1 billion in equity. They've done 85 acquisitions, and they couldn't have done it without being a publicly traded vehicle. Now, having a system where the threshold to an initial public offering is within reach of emerging companies has a secondary advantage, whereby in addition to launching new local companies in new industries, we could also see companies arriving from elsewhere. I don't know if you've been to Silicon Valley, but there's a place called Sand Hill Road. When you show up looking for money, they direct you to one of the local venture capital funds, and if they like you, you don't go home. And that could happen here, the inverse. If you go to Silicon Valley today, you have a challenge there. The entrepreneurs are being targeted by the giants. 5 companies have $500 billion in capital. And even the venture capital system is being overarched. And there are entrepreneurs that really want to stage their growth. And that growth staging is possible if you can come to an environment where that calibration is facilitated, like the TSX Venture Exchange and the Capital Pool Company and the junior independent dealers and people like Mick that are prepared to sweat blood to bring new companies along. You know, our needs in Alberta are not unique. Regional growth policies are discussed everywhere. The problems with concentration of wealth are the result of concentration of financial power. There's no reason why what happens in the United States is a matter of a revolving door between the SEC in Washington and Wall Street. And yet, you know, going back to the formation of that country, they acknowledged this could be a problem. They created 5 offices of the Federal Reserve. They had securities laws in every state. To this day, they're still recognized. They're referred to as the blue sky laws, but they're dormant. And yet, regional markets result in diffusion of wealth, which is not being addressed. I'm amazed even in the American campaign, this has never come up. Our government is paying attention to this. The fact that we opposed the national regulator was good, but it's just a start. And when I think back of complimenting Bill Rice, the former chairman of the Alberta Securities Commission, asked him how I could help. He said, "You want to help me? Explain to the cabinet what I'm doing." Half of them don't understand it. So these charts and flows have been evolved in the course of trying to communicate to policymakers. And we need to, at this point, I think, zero in on there's a weak link in this chain, and that's between the venture capital funds who are tending to squat on all the money they're getting from government rather than kicking them out and moving it on to IPOs, or at least M&As. But when a merger and acquisition takes place, chances are it goes south. It's selling out to Google. So we need more IPOs. We need more independent investment dealers. And this is private sector, but it's got to be condoned, it's got to be encouraged by policymakers. And I guess, you know, I'm here on behalf of Athabasca, and I'm saying our mission is education, and it's education everywhere from the level of financial literacy in the broader public to financial literacy at the level of our policymakers. And that's our message, I hope. Thank you.
Well, thank you, all of you, once again, for sharing your thoughts, and thank you, Russell, for your passion and enthusiasm for bringing this topic forward. We're just going to take a brief intermission for the next 10 minutes or 15 minutes, come back in at 2 to 3, where we will then resume our Q&A session. So if you could come back in here in 10, 15 minutes, we'll continue on from there. Thanks. So if everyone could just find a seat, I've got 4 faculty members here they're going to help me with the next part. We have 2 microphones. Hussein has one, and Merlin has the other. And Eric and Pam will try to keep an eye on where the questions are, and we got Hussein and Merlin running around up and down the stairs, so they were elected. So please raise your hand when you have a question, and one of our faculty members will make sure that you get a microphone to ask. And I do ask you to use the microphone because, as you know, we're live streaming this and we want to record everything. And as you ask your question, if you wouldn't mind, please say your name, where you're from, and then get into your question. So I think we're ready to start. And our panel is ready to respond. So can we have questions? All right, there's, okay.
Hi, my name is Christopher from Canmore. And this question is for Darren and for Mick, probably as entrepreneurs. We've seen there's a downturn in the numbers that you mentioned, Darren, the number of financings and that. But are we over-regulated? Because as entrepreneurs and as investment dealer, we haven't seen fees from TSX go down or wages and salaries of people at the Securities Commission go down.
So sorry, what was the question?
Are we overregulated?
Are
Is
we
Lynn,
overregulated?
is Lynn Susumi from the Alberta Securities Commission still here?
Yeah, there we go.
Okay.
I should
Yes.
maintain a low profile.
I'll take it first and then hand it to Darren. Yes, we are overregulated, but I want to pay deference to what Lynn and her colleagues at the commissions have done, and I'm not advocating a rollback of the regulatory clock. What I'm advocating is the burden right now is placed on public companies and the directors and officers of those public companies. The cost of compliance is very high, to a point where any public company just meeting its base compliance costs these days is probably $100,000. So the challenge for the commission is to innovate, and I think the exchange as well. For example, I was at an annual general meeting of a company last week. It costs them probably $3,500 in legal fees. It costs them in other fees related to that, hosting the meeting, et cetera. There's not one single shareholder from the company there. So why aren't they going to internet voting? Why didn't that vote happen virtual in that realm? I'm not advocating that we rob shareholders of their rights. The exchange is there to make money. I realize that. They bring in an electronic filing system, yet their fees don't go down. So I think it's a challenge for everyone. I think we are over-regulated in the sense that we're not utilizing technology and innovation to reduce the cost of the regulatory burden. But again, I don't want to for a second turn back the regulatory clock, because unfortunately, every time that's done, we have charlatans and bad actors that go out there and take advantage of the system. So, Darren? You can chime in too.
You know, I agree a lot with what Mike has to say. I had to say that the Alberta Securities Commission and the BC Securities Commission have been innovative in, we have, you know, you've used the word dinosaur earlier on, but we have other securities commissions that are more dinosauric, and we haven't seen that in Alberta and BC. We've seen them be very dynamic and move forward and bring assist in getting new exemptions pushed forward to assist the public venture capital markets. What I would say is, and you know, I've done this several times to be dramatic, as Lynn knows with a couple other members of the Securities Commission, is that when we have a CPC do a qualifying transaction, the circular is 400 pages long. And then I took in the Alibaba prospectus, which was 92 pages long. And I go, how can that be? Right? And so it's not necessarily the fault of the Securities Commission. It's just this regulation for regulation's sake by everybody piling on. And if you ask one of my clients, do they want to get this 400-page circular in the mail for a little CPC they put $800 into? Not a chance, right? And it is that Mike is right, is that they have not moved to the digital format on any of these things, but also nobody's asking the question, why are we doing this? There are lots of answers out there, but nobody's asked, what was the question again? And that's a problem, and it was all pushed towards making the investor more informed, and it's done the exact opposite. It's been so burdensome that investors don't even want to read this stuff because it's complicated and they can't understand it. So that's where, by and large, security costs have got out of hand, is right factored in there.
Yeah, I just can't resist the bait here, so just jump in. But I totally think there's obviously a push and pull on this. With any regulator, big R or little r, whether it's a commission or exchange, you're always trying to balance access to capital, AKA the corporation, with investor protection. And I think that can get out of whack or in whack, and the pendulum will swing. I think that there's a lot of opportunity.
Is your microphone?
Did I turn my mic off? I did.
I turned it off, actually.
I didn't know you were a coder. You're like coding the thing. So just to repeat really quickly, we're always trying to balance that off. The commissions are, exchanges are, access to capital with investor protection. And I'd agree with you right now. I think there is a high level of regulation. I think that 16 years ago when we launched the CDNX, when we merged all the junior exchanges, the exchange rule book had a big role to play, because where corporate law left off and securities law took over, there was this big gap. Nobody's dealing with pricing, backdating options, or pricing of placements, and who's going to protect you when you're at work and your investments are trading at a certain price and other people are investing at a price lower than that, right? So the exchange needed to step in and do that. So I think there's a whole sea of things, and to give, you're right, the Western Commission's credit, they have come out with ideas. Tom Graham a couple of years ago came out with a much lighter touch opportunity. So I think those are all good. I agree with you. Where your question was about costs and salaries, sometimes I want to just put some perspective on it, like pan way back out like Google Maps and look at planet Earth and show me one country in the world where for $40,000 you can list on a regulated, fastest exchange in the world, the best disclosure system, international investors, et cetera, et cetera, et cetera. So I think that we've done a lot and do a lot for issuers. We need to do some other stuff around dealers and everything else. So when I hear $100,000 a year for all the public company governance, pause for a second. And I'd like to know how many people think that's high or low or medium for a public company, whether it's junior or senior. I think people have to look at it realistically. And at some point, you got to pay to play, and it's an opportunity. If you don't feel that you can get the gym pass to get into the public markets for $100,000 a year, and if you don't think you can perform enough to make at least $100,000 more return from using the public's money, then maybe you shouldn't be on the public market. Mm-hmm. You gotta think big and balance it. So that's my main point.
Sure. Let me give you a more pragmatic example. I'm a director of a bioplastics company in Vancouver. We're doing a private placement. It's exempt from any requirements. Out comes a 64-page subscription agreement, okay? And by the way, the colloquialism for those deals that Darren did, they're called doorstopper deals, because the prospectus is so thick, or the offering document is so thick, it'll actually hold a wooden door back. But anyway, so I phone up a lawyer friend of mine. He's invested in a bunch of my deals. Murray, take a look at this, please. He's going to invest $10,000. Then he gets the 64-page subscription agreement. He says, Mick, I apologize, but I've been in trust law for 15, 20 years. I've worked for some of the top firms in Alberta and Vancouver. I can't understand the subscription agreement, and this has got me very nervous. I'm out. That's, Chris, to address it, I think we have to challenge ourselves and work together with the commissions and with issuers to reduce that regulatory burden. Because as I said, I have no problem with proper compliance and full, plain and true disclosure. I just resent it when the issuer and the companies are bearing most of the cost of that. And let's find a way to cost share that, and let's find a way to use innovation and technology to reduce that burden.
Great.
Yep.
We have another question.
So I remember the times of Murray Pesum and Larry Rickman and those types of deals, and yes, I can understand why we need to keep the charlatans and the bad actors out. The $100,000 entry fee, it is a lot of money, especially if you're a mining company, a resource company, and you're trying to put some drills in the ground. It can get rather prohibitive at times. And I think what you're seeing is now you're starting to see a lot of private capital firms start up that are saying, here's my agreement, and we don't really know how many shares are really out in these companies. We're taking a trust on these capital groups. Now, some of them are great deals, and they'll go public eventually, but you may have just put what you were trying to achieve is keep the bad actors and the charlatans out. You may have just put them private underground, and you still might not be protecting shareholders. There's got to be some gap in there. You can't look at the numbers and say, this has gone backwards dramatically. There's got to be something in this space that you got to fix. You just look at the numbers, it's broken. I don't know if I've heard yet the solution to what's broken. I just haven't heard that solution
Yeah,
yet.
well, I think there's a couple quick things that I would react to. I don't mean to say that 100K is just peanuts, it's in your glove box. I think that when you look across, everyone says public costs a lot. Okay, so I'm gonna go to a VC. I'm gonna go to private equity, because there's too much burden. There's a doorstopper prospectus. Guess what? Most of the VCs that we have clients come back with are doing triple the reporting to that VC or that PE fund, and it ain't quarterly, it's weekly. It's weekly, okay, let's see what your trial balance is, your receivables, what's going on, what's your turnover, inventory, what's going on, and you know, it's endless. So you have to full cost account for the options, right? You can't just look, there's an invoice over a year, and the entry fee is actually much lower than that. And by the way, when you go public, by the time a lot of the other actors take capital out of it, the real cost going public is 400 to $1 million, right? So where the venture exchange comes in is 40 grand to come in. So I've mixed a couple of concepts there, but you have to full cost account that. Everyone's accountable to somebody, right? If you borrow it from your uncle, you know, he might be a pain in the ass, and that's a different cost. So that's one comment. Maybe gray hair, that's the cost you get. In terms of solutions, I'm glad you raised that, because you know, we didn't really get into that in the talk that I gave, but there are a number of pressure points that we need to apply some relief on. One of them is the issuer side. So we've been working on that over the last couple of years, both at the TSX and at the venture side, and that'll continue. We're looking at alternative platforms. We're looking at different tiers. Should we now move to more caveat emptor and apply for that in certain sectors? Should we be reminding the regulators and the players that this is it doesn't say business exchange or company or corporation or commercial exchange, it says venture. And if it's a real venture, then you ought not to be applying all the same tests and standards to a venture, because by definition, it's not a going concern or a commercial thing. So how do we get more of that risk back on and more caveat emptor? So I don't disagree. I think that's a spot where we can make a difference. And the other thing is just having more capital coming into the market. So we have to go and say, we can't just rely on, yeah, there was Yorkton, and yeah, there was, you know, Byron, and yeah, there was all these firms. We're going to do work on them to try and give them some stimulus. So it's not an impossible job to start up a new investment boutique, but we got to look for new communities of capital to bring them into the ecosystem. Corporate balance sheets across the world have more cash on them now than they ever have. Look at where interest rates are, et cetera. So you talk about, I think Ross, you were saying earlier about the VCs getting pushed out of the way because the entrepreneur, Cisco or Google or whoever, just says, we'll take it straight. We need to get some of those corporate balance sheets involved in our market as a platform too. So there's not a silver bullet there, and I won't even get into commodity cycles and where people are right now with the junior market. So it's a multifaceted solution for sure.
There's a point in there, sorry, that I wanted to follow up with Ungat. I don't want to hog this, but he made a very good point, and for the entrepreneurs in the audience, and of course, corporate governance is, I'm sure, something that Athabasca has at the forefront, as a lot of people do, people sitting as board chairs, and what do we do in terms of governance. But if you are an entrepreneur, even in a private company setting, I think it behooves you to prepare financial statements. You don't necessarily have to go to an auditor. Supply your shareholders with financial statements. Be more open in your communication with shareholders. Give a regular update on what you're doing with respect to the company. Because I think that's something that gets lost in translation here. And as Ungat said, if in fact a VC firm or PE firm invests in your emerging company, you are going to have to report quite heavily to those. You're going to have to do one-on-one meetings. You have to do quarterly financial statements. You're going to have to do budgets, et cetera. So that exercise, and guys, men and women used to yell at me, you never read those things. Actually, I did read parts of those things. And preparing business plans, preparing financial statements, it's the exercise that really is key there. So I think that's important for entrepreneurs, is treat your small business like it's a big business. Treat your shareholders as though they are public shareholders. They're entitled to full, true, and plain disclosure of what you're doing in your venture.
Dave or Leah, do you want to comment?
Glynis Middleton, business consultant with Stantec Consulting. Thank you all for your comments. This is a general question. I've been consulting for many, many decades in Alberta. And one of the things that myself and my colleagues have often marveled at is how far Albertan companies can get without actually knowing how they got there. And so much of the work that our incubators and midstream stakeholders, not necessarily investors, have been trying to close the gap on knowledge, so educating those entrepreneurs on how best to run their companies, make them more efficient, make them more competitive globally, not just in Alberta. So my comment or my question is, what role can we play, business-minded people, in bringing that literacy up to the global level, just not just local?
Good question.
Great question.
Do you want to take it, Russell?
Well, this is about finance, and what we've explored at Athabasca recently is financial literacy. Once upon a time, people could take the Canadian Securities course, whether they were in the business or not, whether they wanted to be in the business. You signed up for the course, immediately you understood the basics of running a personal portfolio, investing in a little company. So we looked at that further and discovered that the state of that course is now the property, in effect, of, or went through the process of being the property of the Canadian Institute of Banking. So the Canadian Securities course is basically a profit center that the Canadian Institute of Banking decided a little too close for comfort, so they sold it. So they sold it to Onyx, which is a private equity firm, which is basically a deal shop, who flipped it in turn to, get this, Moody's. Now, I don't know, those of you know or don't know Moody's, but they're part of the folks that brought us the subprime meltdown. It's an American company that is involved in publishing and education and what have you. So they are controlling the minds of our population that could have access to financial literacy. Well, we're going to access that course, and we're going to morph it back into where it belongs, where people can understand the basics of investment management, investment banking, and commercial banking, and where those things fit. So it's hard work, but this is part of the mission here, Deborah, isn't it?
Yep.
You know, and just following that question, when I was way back when I was in MBA school, and so many of the courses I took, it was all project driven, and they all ended up with, and then the company went public, the end. And I kept saying, I think there's more to it than that, right? And I guest lecture at the University of Calgary a couple times a year, and I speak in the New Venture business program there. And I go back to that story, and I still think the same thing happens now, even with the New Venture programs, is that they go, okay, then we're going to go public, and it's, okay, we're done. Did we get an A? Kind of thing? And I really think there's a gap there as to, okay, well, then what did you do as an entrepreneur? You got this company, you built it, you went public, but then what did you do? And there definitely is a gap even in the education system with regards to that.
Okay, just Leo?
Yeah. I'm dealing with that issue on a more basic level. I've parted company with entrepreneurs that were just totally unmanageable because they didn't understand that if somebody wants to provide you capital, you have to actually provide them with the reason why they should fund you. But there's an equal problem on the other side. I find that now that I look at how typically we assess entrepreneurial type situations, it's ticking the boxes. I don't think there's a deep understanding of the technology that's being funded, and as a result, I think a lot of companies are not getting funded because, as someone mentioned earlier, I guess you did, Dave, you know, when a banker doesn't really understand what he's investing in, his tendency is to say no, and I think that's a pity because a lot of these companies probably ought to be funded. But it is a bit of a dialogue of the deaf, where on each side, people don't understand what the other is doing. In fact, a lot of what I've done in the last year and a half is sort of along the lines, trying to teach the entrepreneurs finance, and they're trying to teach me, I don't know, chemistry or whatever the heck they're involved in.
Because I think sometimes we have this desire to educate entrepreneurs, but it's almost beating the life out of them. Like it's this desire to have things neat and tidy, which is what Leo's just explaining, kind of banking. I've been at this a long time, and you can have all the courses in the world you want if lots of times they just want to go. And so I think it's having little on-ramps for them every chance you get that has the ability to support them. People get partners for a reason. They complement each other. And I think if anything, you know, in the various points of schooling, whether it's high school or university or whatever, is just, you know, that entrepreneurial. You don't have to learn a hell of a lot. You don't have to be able to get a business degree to run a business. There's a few things, and I think if we concentrate on them, you know, like teaching kids the time value of money, you'd be amazed how many 19-year-olds have a $50,000 car loan and really don't have a concept of what that's. But so it's not a big deal. Like, it's not a great, huge, long course in how to run a business. It's just, you know, if we kind of thought about it strategically, where you'd put that in the school system to make sure people have some of that grounding, it would help them a lot.
Although everyone needs an Athabasca business degree.
That's true.
Yeah.
What a suck.
Touche.
Gotta love it, yeah. Okay.
Ian Morrison, Project Economics at Stantec. You've talked a lot about different things and different parts of the puzzle. And we can all think of jurisdictions that have been very successful in this process, whether it's California, whether it's Massachusetts, or whether it's some of the Asian jurisdictions which have a different system altogether. But the Alberta context is different. And so the question I have for you is, in the Alberta context, what would be some of the major tenets that you would see for a successful capital, a capital and financial structure? What do you see that Alberta needs to do to make it efficient for entrepreneurs to go up the scale to become major world-class companies? What are the 5 or 3 things that you'd say?
I'd say that what's different about Alberta is, you know, particularly when it's related to energy or anything like that, the gestation period is much longer and the capital intensity is much higher. Now, when I talk to some of the pension guys in Toronto, they invest in apps. Well, what is an app? I mean, the guy puts it together, it starts to generate revenue or does not, right? It either dies or it goes up in a very short order. A lot of companies in Alberta need to work for 10 years before they actually have a product that sees the light of day. That's it. And then to commercialize it, you often need 30, 40 million bucks, which is very different from what happens in a lot of other industries. So I think that's one crucial, well, a couple of crucial differences from what I see elsewhere.
I think, back when I started in the industry, so why were there so many more public companies then than there are now? And the answer was because back then there was this huge mountain of cash that you could not access unless you went public. And so everyone went public to get access to that mountain of cash. And now what's happened is that mountain of cash is significantly dwindled for all the various different factors we've talked about today. So there's not as much incentive to go public for these companies because they're not able to access the cash. And why is Silicon Valley, why is it so successful? Because there are mountains of cash there. Yes, they have a great climate and the geography is wonderful, but it's because there are mountains of cash there. And unless you create an environment where there is capital available, you're not going to draw the entrepreneurs. You know, in Toronto, they built the Mars building, downtown Toronto, and I really scratched my head. I said, they're building this in the most prime real estate in Toronto. They're putting this headquarter for entrepreneurs to go down there. But entrepreneurs need to be out in the boonies, out in a warehouse at $1 a square foot rent. They don't need to be downtown at 40 or 50 bucks a square foot rent. And so it just seems to me it's out of sync, is that the entrepreneurs, they need to access capital. Entrepreneurs burn through capital.
I think money will follow entrepreneurs. You can't create a pile of cash if there's nothing to do with it. So the pile of cash did not start in Silicon Valley. It's the people.
But you have to create in a
Yeah, so you send them all out to the boonies and there's no hub of people. Silicon Valley is about a hub, it's about people, it's a cluster, there's so many, there's deals made in restaurants, it's just, and Massachusetts is exactly the same thing. You got the universities there, and the piles of money just follow those people. That's where you want to invest.
We had a friendly environment for capital, and I just
people.
think the environment
Alberta
here is
doesn't have enough
unfriendly.
people.
Doesn't have enough people?
Right. We don't have enough people to develop the resources we have. We never have. And if we keep whining about money, it's never going to come. It's got to have people and companies here. And I think it's the bright people who can attract money, and the money will come. Venture capital doesn't care whether it's Silicon Valley or Alberta or Saskatchewan.
No, it doesn't.
So you give it deals, it'll be sitting right on your doorstep.
But how do you get the deals?
The people. You got to have the people developing.
But how do you get the people?
Universities, technical schools, smarter and smarter and better trained people in a variety of skills.
We have those though, and they come out with the ideas, and there's just, they don't know where to turn. There's no capital for them to get.
There is. The capital doesn't care where you live.
Yeah. Guys, just in fairness too, we're really talking about scaling. Scaling.
Scale as well.
And scaling is a continuum. And that's why these charts that Dave and I have developed try to show. You know, back when, again, I was trying to help Bill Rice, people would say, money, money, we need money. And I'd say, what do you mean by money? Did you know that the Inuit have 20 words for snow? All right, well, this helps us to understand the nuances of capital. There are different kinds of capital. And if we understand that continuum, and we can navigate that continuum, that it's all there. All the tools are there. It's a matter of navigating that, the skills in accessing. What did Blackstone just come out with a stat that in terms of just raw cash in the world, there's $50 trillion in cash. So you really have this barbell configuration of all this cash out there, and then when you look at the exponential growth of technology, I don't know, those of you that have followed people like Diamandis and the singularity and the exponential growth is going to change the world, well, that's investment opportunity. So it's people like us that are the choke in the process that can facilitate that connection. Hot wire. So scaling it along the way is really what it's, I think, what it's all about.
I think that's 3 and you asked for 5. And the other thing I think Alberta entrepreneurs need to do is not see the world with borders, right? Like north-south and east-west, and that's not the way I look at it. Like, you know, I go to Toronto, I go to Montreal, I go to Ottawa, I go to Vancouver, go where I can find people that will help me get to where I want to be. And I think all too often, once entrepreneurs get to a certain comfort level within the province of Alberta and doing well, as they try and scale and reach up and build that world-class company, they don't have the bridges. You have to build bridges. The financial world, the entrepreneurial world is growing in complexity about as fast as the computer world. So my advice to any entrepreneur in Alberta is build those bridges across provinces and across countries. Now, not when you need them, build them now.
I think, I agree. Just to quickly chime in, I think a unique value proposition that's very motherhood to say scalability, and I think we need to diversify also away from these very capital intensive, long-term, maybe they relate to energy or energy technology, I don't know, but that's where the diversification comes in because there's so much exciting things going around. Right now, the US VCs have never been more excited about the Canadian landscape for technology, whether it's Shopify or Hootsuite, whether it's in Mississauga, or it's in Ottawa, or whether it's in Vancouver, or here. We have a great homegrown company, well, at least in Calgary, Solium. They've done extremely well through using the markets and good technology. So I think that's what that's what I think these days would be. Not to say that the other business models wouldn't work, but yeah, you have to have the good idea where the investment thesis is, I give you $1, I'm gonna get 4 if I like the story, right? That's the greed, that's the return, and that has to kind of be there. So just
At the same time, when you look at the return on Canadian venture capital, it's a lot lower than it has been in the US.
Yes.
And I think in part it's because there's nobody to play catch at the end. There's no commercialization money.
Exactly.
Right?
Exactly.
So if you want to change that, you have to fix that problem.
Although I agree with you, I also like Mick's point is that, you know, when you log onto the net and you want to do something, you want to research something at night, you just go all over. There's no borders. And the reality is, if there's not a commercialization opportunity right here, it doesn't mean you can't get to it. I mean, physicality is important, but at some level, there are, I think there's so many, there's women in capital markets, there's talent capital, there is networking, angel investors, PE funds, social investing, social bonds, environmental bonds. Like you can
Family offices.
You can get capital that people actually don't want a financial return to both. Like I'm just saying, there's a lot out there. You got to get out there and start to socialize with what you need and sell your story and then find out what you can do with it. So it's not perfect.
Just want to add a comment here to Leo's statement. You understand what performance means in your world, capital P, performance. The problem with our culture, and including venture capital, don't go there. If there was a brighter light shone on performance in venture capital management, and this really starts from the big institutional investors behind the VC funds, then maybe they would be a little bit more propelled to see liquidity events and demonstrate performance. Right now it's kind of murky. If you look at the Canadian Venture Capital Action Plan, the 400 million times 3, there's basically 1.3 billion that's been pumped out through the VC world. I haven't seen any performance measurement. There's an outfit in Boston, Cambridge, that monitors the less liquid world, not the Morningstar world. And they won't be allowed near the Canadian VCs. So we need a little more hard-headed IRR performance measurement in order to get better performance. After all, you measure what matters.
There's an underlying problem. And it's a catch-22. If the return is poor, then the exit provisions are not as attractive, and the reverse. Because if you want more long-term pension capital or endowment capital to flow in that direction, you have to solve both the exit problem and the performance problem.
One of the reasons that there's an exit problem is that the VC world and the junior capital market world see themselves as competitors. For sure, the VC world, I can tell you, sees the junior public markets as competitors.
Well, I think that's right. It's going to take a long time to change it. It is changing, and quite frankly, they have two messages. The public message, which is, oh, we don't play in public markets. Yeah. But I can show you enough information circulars on CDAR that'll show you how many VCs do use the public markets. But I take your point, 100%.
So we have to put pressure and heat and light on the VC managers so that they communicate, engage your world.
Let's take another question.
Thank you. My name is John Elson. I'm from Calgary. I cheer for the Flames.
Next question.
I'm elderly. I'm here to speak on behalf of the nearly dead, according to the Calgary Herald anyway. I've been in Alberta for quite a while and have been diversified God knows how many times. It started when I had hair, and every time I lost a little bit of hair as I was diversified. But it seems to me there are two aspects to this. One certainly is the economic, but the other is the people. And I don't hear a whole bunch about people. In 1982, when we cycled, my son graduated as an engineer. The year before he graduated, there weren't going to be enough engineers to look after the jobs. The year he graduated, he couldn't give his degree away. My grandson today is an apprentice electrician who is very concerned that he's not going to be able to find a job to complete his apprenticeship. So in diversifying Alberta economy, are we looking to try and generate jobs? Not everybody can be an entrepreneur. Very small percentage will ever be entrepreneurs. So what are we looking to do? If we look at a resource-based economy, they go through cycles, and there's abandoned resource towns all over the place. and in the extreme, Fort McMurray will be abandoned. I don't know how many years it is from now, but it will be. So can we create jobs to keep our labor pool at work? Can we create jobs for youth? Where are we at?
I think it's very tough to predict that. When you go through northern New York, you see the same process 100 years ago, right? You get all these abandoned settlements that at one point were somebody's dream. But structural change does that to you. I mean, Alberta wasn't here in the same way 40 years ago. If we don't become more competitive, we will not be here 20 years from now. People will live in BC or Ontario instead. But your more general question about where are the jobs going to come from, I think that is the fundamental concern parents have about their kids and their grandkids, because we don't have as much visibility on that as we used to. The notion of a steady job in a factory and so on is probably was never probably true to the degree we now think it is. But the rapid structural change in the economy means that you're going to have to retread a lot more often than you used to, which again is where education comes in. I'm not trying to be a suck here. But I went through 8 career steps, right? But it was more or less sort of a morphing from one aspect to another. The problem for the next generation is likely to be that they may have to do something completely different halfway through their career because structural change is happening so fast. So diversification is limited in what you can do. I mean, Alberta is here because of oil and gas, okay? Full stop. If you double the size of the ag community or tourism or anything else in the economy, you wouldn't get to where energy is. And a lot of the stuff that's here in construction and retail and so on is again here because the people that work in the energy sector. So without that cluster of activity, it's going to be very hard to maintain Alberta growing the way it has in the past.
Maybe I can add, and I think it's a great big picture question, and our innovation sort of roundtable, blue ribbon panel, whatever you want to call it, that we've started out. The whole discussion is, yeah, it may not be the panacea for exactly what the problem is here, but this channel of starting with the entrepreneurs, targeting scale companies. We're actually not even really focused on startups. We think startups in Canada have more than enough support. That's debatable. Some people will agree or disagree. We've got shred credits that put out billions of dollars. We have no end to it in our view, at least the people in the roundtable discussion. Scale up companies that need to scale, that addresses southbound sellout, brain drain of talent, and as those go, that drives jobs and economic development. So as you work back through the chain, all the things we've been talking about are critical to get those companies scaling, because then it's jobs and then it's redeployments. The question is, we don't have all the time in the world. How do we get there fast? And what a lot of people are talking about is technology has never been more free. You can go grab something. If you got an idea, Canada Goose or whatever your idea is, you can scale it so fast by going to Toby Ludke's Shopify.com website based in Ottawa, and within a day, you've got a storefront up that looks as slick as Saks online. Now, I'm not saying it's easy, but I'm saying that is what the innovation minister and the federal government and everyone's looking at. How do we get there? Because if it's just energy, that's a very big bet, right? Or big situation we're already in. So again, it's not the silver bullet, but that's how it gets going. That's how Stantec would have got going, I think, what I'm hearing, what I'm learning today. Yeah.
Thank you. James Freeman, I'm the CTO of ZEDI, and actually, we're one of the companies that you've been talking about today through all of your comments. We're an example of an Alberta-based company that was incubated here, survived startup, sold technology to the oil and gas industry, went public on the venture exchange, went private, because we just weren't getting what we needed off the venture exchange. And a lot of the things that you discussed was definitely the reality when I was an officer of a publicly traded company. And we're stuck. Oh, I should also mention we are an ATB customer as well, so thank you for that. And we're stuck. We've been able to scale to a certain size while remaining in Alberta. And now what we're doing is we're saying, well, look, we've built a business model that has been successful for the oil and gas industry, and we're prepared to play in the diversification of this economy. And we're actively starting now to look at how can we leverage the technology that we've built, the relationships we've built, the scale that we've built while staying in Alberta in other industries. So that's where we're poised. Mike, I have two questions, and I think you both alluded to some of them. One of them is in April, the Alberta government announced an investor tax credit, 30%, two-year program, $90 million cap. We haven't talked about that yet today, but do you think that the way they conceived of that program is going to give a kickstart to any of the aspects that you've talked about in terms of capital markets? That's my first question.
I think it will. It's very successful in Quebec, and it was very successful in British Columbia. So it takes money out of people's savings accounts and puts it into businesses. It tends to be people you know, like it's not going to be some investor that you've never ever met. What it tends to do is get Leo investing in one of his ex-employees or a relative or one of these engineers he's been hanging around with or something like that. And I think that's good because it's not money that would otherwise get invested. And I think that's what has been talked about a lot here is, did we lose our mojo for taking risk? And so we're weird as Canadians, but this idea that if somebody will give me a tax break, I'll take a completely disproportionate amount of risk just to get my 15% deduction, which I don't get. Like you can get the same thing by putting money in your RSP. Actually do a little better, but at ATB, did I say that? So yeah, I think it will. If you ever have an opportunity to talk to any of the government or policymakers, they always want to dial it down so tight, so we only get people on the odd side of the street. We don't want any oil and gas and this and that. And so I think I would just, if they were, I guess Richard is here and he's an MLA, I would just try and make it as broad as you can because it's so hard to define what's an interesting technology for Alberta. I wouldn't go there. I would just try and get the investment flowing into companies' hands.
And I think that, I'll follow on from that. And I've always had difficulty understanding why if I buy shares in TransCanada Pipe, I get the same capital gains exemption as if I bought shares in ZI as a public company, way back when it was a public company, because the risk continuum is completely different, but I'm getting taxed the same, so there's no incentive for me as an investor to take that extra risk, because I'm going to get taxed the same, even though my risk is disproportionate. And so I think that the investor tax credits are good. I think that you're exactly right. You need to broaden it, not narrow it. And I don't know exactly how you do that, but if you pick a number and you say less than $500 million, and then there's only 25% capital gains tax on companies like that, if you're an investor, because then at least you're getting some kind of reward for that risk.
Yeah, two things on that as well. We're very successful in British Columbia, and I think Dave, you gave an excellent overview of that program. The one thing for your entrepreneurs you got to be careful of is their allocations per year. So in other words, the door opens up, let's say it opens up on March 31st, and the door will close on May 31st. So you have to be at the forefront. And what will happen, much like they did in British Columbia, there will be a couple of accounting firms and a couple of consulting firms that are at the forefront. You owe it to yourself to find out who they're going to be. Sometimes the government can help. Otherwise, the large accounting firms are typically involved in some of the smaller accounting firms. So if you're going to use that program, and it can work out very well, be at the forefront of it. Otherwise, the door closes. They typically in those programs, let's say in a $100 million program in BC, they would have $300 to $400 million in applicants. So you really got to be ahead of the curve if you're going to use that program.
At the risk of piling on just really quickly, so we've been on the record as an exchange with Morneau's office and I'm presenting to a finance subcommittee on the 9th. We're talking about all these, as we have in the past, talking about all these things. So a Canadian-controlled private corporation has a whole list of different advantages they get, from qualified small business corporation deductions to allowable business investment loss, which are actually better than a capital loss, because you can deduct it against T4 income or whatever. Flow through, taking the success of flow through and taking some of those attributes and put them into what we need here, which is technology, or if people agree, and to scale. So we are pushing that. I think we've got to continue to push that. I think the thing to remember personally, and I'm not a GR specialist or government relations specialist, is that I recognize that every one of these great ideas that we come up with to help where we're working is an expenditure on their P&L of the government. So you have to think carefully, or have somebody who knows the public accounts and can say, okay, well, you can take it from there, kibosh that, because guess what? They've had 25 years of use of it, and we're going to port it over, or you put quotas in. But we're very much directionally aligned with what you've said.
And if I may, a second question would be around corporate structure innovation and impact investing. So things like a B corporation. And do you see a role in our province here for impact investing in any material way? You know, where there's more of a social cause to the investing, and then a corporate structure that can pair with that to make that possible and attractive for people?
Well, I can tell you from, I'm not sure on the corporate structure matching up with that part of the question, so I'll hold that for a second. But as it relates to environmental, social governance, ESG, we have done a number of studies across Europe, across the United States. That sort of buy-side or asset manager bias has been increasing. So it behooves you to look and understand, if you're seeking capital from these people, to understand the template that they have at their listing committee, sorry, day job, investment committee at those funds, to look at it. Because yes, it's not always financial return. So that is increasing. So there's a whole bunch of groups out there, and the TMX is involved as well, the UNPRI. There's a lot of stuff there. As for the structure, I'm not sure I understand the question. I know there's a lot of thing about triple bottom line reporting and financials. Maybe if you can clarify it for me.
I'm a CTO. I'm an engineer. I'm the guy you should be hanging out with to give me money.
All right, good.
But my understanding is in the United States, there is a structure called a B Corp, which is
we
a
have
flow.
a B Corp in Canada
we do?
as
Okay.
well.
You would know way more
The
about it.
Business Development Bank, one of the Crown just came out, and they're a B Corp. So it's just having a different set of criteria for your company. So if you Google it, you'll see what that criteria is. I think the impact investing, I think it's going to get, I would say that to have a strong society, we need a real strong business community. We need strong government as policymakers, and you need that whole nonprofit sector as well. And I think what the impact investing and nonprofits are going to learn from business, they're going to take on business skills, and that will make them better and better and less reliant on government. So we're seeing more social enterprises, so people that do their mission by running a business which starts to cover some of their costs. I'm happy to talk to you. It's some fascinating stuff going on there.
You've brought up some really good points, and in that regard, I'm happy to see how many women there are in the audience and in finance. And I think that's something, as women, you should go to your MLA or go to the government, and you should have more women-only funds. It's much more prevalent in the United States in terms of women-only venture capital funds. I brought that up at the Canadian Venture Capital Association Roundtable as to whether or not, when they made their pitch to the government, they were going to make a pitch for women-only funds. And I can tell you, I basically got shouted out of the room. And I was the only one who brought it up, apparently across Canada. So you will see more of that, but I think as women, you've got to fight for it, right? You've got to make it important in that regard.
Thank you. Got a question?
Deborah, since we're getting to know our audience better,
Yes.
there's a poll I'd like to take. How many involved in private sector business management? Let's define it that way. So we got a pretty good audience here, eh? And so anybody there could be an entrepreneur.
Don't underestimate what it takes to be an entrepreneur. When I watch these guys and how hard it is to get a hearing, even for a really great idea, it's not just a passion. There's no lack of passion in these guys. But finding someone willing to take it through that ramp-up period.
Oh, yeah.
With all due respect, Leo, if it was easy, everybody would be doing it.
No,
I think the
I'd
tools
rather-
are, to counter that, the tools, as we had up on the continuation chart, the number of incubators, accelerators, now the VC program, everything that's going on. I'm a guy who's traveled back and forth across the country last week to a point where I don't know where I am.
No,
But
exactly,
there
that's
are, the
it.
tools are there, and I think, much like we talked about your son or grandson going in as an electrician, there's no better time. When jobs are scarce, what do you have to lose by going to try and be an entrepreneur?
I think that, if you have the passion to do it, and it's part in your DNA, some people just can't work for somebody.
Need to be a bit off.
Yeah. No, honestly, but that's the thing. I've often debated that with some entrepreneurs. Why the hell are you doing this?
Yeah.
You're banging your head against the wall and, you're making some progress, but it's awfully slow. And to get the attention of the big long-term investors you need is not easy, and even for a great idea. And part of the reason is the complexity. I mean, everybody understands, and again, coming back to the IT and the unicorns and apps and all that kind of crap, that's not what we do in this province, okay?
I'd argue it is what we do in this province. Some young gentleman came up to me today and showed me some geo app that he was developing. Is he in the audience? Can you stick up your hand? That's Leo was developing it. So I think it is, Leo. I think with all due respect, you've got to open up your mind, really. That's what's happening. It's there, and believe me, I may be a dinosaur, but every day I strive
It's
to
a
keep
very
an open
small
mind.
part of what
Right,
goes
but
on.
what's
in this
involved? It's a
province.
matter of, is it nature, nurture? And then it goes to personality, and it goes to tools and education. Athabasca, suck up here, Dave, is giving people the ability to educate themselves. You've got more tools than you've ever had, and you've got less to lose than you've ever had. So why wouldn't you all pour into that right now? It's not a question, and part of that, you've got to, one thing you have to do as an entrepreneur is adjust. You've been a return guy so long that's what's driven you on the bottom line, and I respect that. But with all due respect, when you become an entrepreneur, you have to adjust that gauge. What is success? I would argue incorporating your own company, getting friends and family, going public, going private again, reaching out, talking to people, that's a success. Those skills you use, that education you get, that intellectual capital you develop is something that will carry you with the rest of your life. It's not a finite thing. So I think the problem is people are afraid of failure. And we all have that, but as I said in my speech, get out there, get after it, be creative.
Yeah, I just, a couple quickly add, I think the current state that people don't do that in this province, maybe that's true, but we've got to sort of say, well, that's current state and how do you get here? And there's not been a better time, again, to try and do that. And I was joking a little bit when I said you have to be off as an entrepreneur, a little bit like a screw half loose. I'm not referring to you, Mick. Well,
mine's more than half loose.
Yeah. A few late nights with Mick in the past, but anyways, it is about a lot of them to have blinders to the logic, right? Because they don't see failures or risks the way we see risk, right? And they just see it as, well, it's going to be another experience, and I'll come out of that with something else. Whereas I would say, like you, you're like, what are you doing? What do your parents think of what you're doing? That's the mindset.
It's not just that. If you're a young guy and you got a family, you got kids, and you got a mortgage, an entrepreneurial career can be very challenging. I'm not saying you shouldn't do it. Just do it with your eyes wide open.
Yeah, good, okay.
I think, the in between here is that the entrepreneurs come to guys like me and they say, we want money. And then I have to put on my Leo hat and I have to say, okay, well, what are my clients going to get out of this by putting money into it? And I hear all too often, well, but I've got a ton of sweat equity into this and I need value. And I say, yeah, but my clients put a ton of sweat equity into what they do to have the money to put into your company. So that's a trade-off. Right? And I think that there are plenty of great ideas, but I sit all too often and I say at the end of the meeting, so what do you guys do? And how do you make money doing that? And so I think that there is, from my mind, the gap is between the entrepreneur and between communicating what they do and why somebody should put money into it is the biggest gap, is because it's, I've got this greatest thing and you should put money into it. And I go, that's awesome, I'm enthused, but how are my clients going to make money doing that? And
That's
if
where
I
the
can't see
disconnect
that exit, which comes back to the exit, then I go, I don't know. Like I'll go to something else.
I totally agree. I heard a pitch in Toronto last week, which was the worst pitch I've ever heard in my life. And we had 10 minutes up there. I think I finished early. It's intimidating to work towards that clock. This person went on for an hour and there was no point to it. And one of the things we haven't mentioned is mentorship. And I think mentorship, I never had a mentor. I started out in law. My principal, I was an articling student. He left the firm. You know, I think that really affected my career in law. And there are certain people in the business community that are willing to be mentors. There's a program in Calgary that I was supposed to sign up for and haven't yet, but I'm going to, about mentorship. And I think that's very important as an entrepreneur, as a young person or older person getting into a newer job, is to seek a mentor. Seek out someone, and sometimes start. I remember I worked in the brokerage firm. I had a guy who was 10 years younger than me appointed as a president of a financial planning firm. And I bought him a bottle of champagne. I set it down on his desk and I said, Paul, congratulations. And I said, this may hurt, but are you getting yourself a mentor? Right? Paul's a tall, athletic, great athletic guy, really a go-getter, but he did not have the academic background or the experience to go be president of a financial planning firm. It just about went under 3 years after that. I often wonder, and he's still out there fumbling around to a degree, I often wonder if he'd had that mentor, what a difference that is. And we haven't mentioned that in the ecosystem, but I think that mentorship, you know, aligning yourself with a person who really knows what they're doing and listening to them. Another example, there's a company in Calgary that's trying to get into a sector. They're trying to educate people in a certain sector. I've talked to that entrepreneur for 3 years. I've begged him to adjust his business plan. He's raised over $1 million. He's still going at what to me is a flawed business plan. I followed up the other day with a friend of mine who's an entrepreneur. He's still at it. There comes a point in time where entrepreneurism turns into insanity, and I'll agree with Leo and Darren in that regard. So that mentor, I suggest you seek out that mentor, and I think one thing Athabasca and some of these other universities will get into is a mentorship program as well. And people like to volunteer. If you think about giving back, you want to give back in a way that's very meaningful, right? There's no point in me sitting as a director of Alberta Ballet, although I'm going there on Saturday night in Calgary. I don't know anything about it.
Not
right?
performing.
If it wasn't Dracula, I wouldn't be there. But so I do try and get where I'm effective, and I think that mentorship program is going to make a difference in Alberta, particularly now when people see where we are and what we need to get ahead.
And just a quick follow-on to that is that when I did my MBA, and I took New Venture there, and you read the text and so on, and getting back, you can't create an entrepreneur through either they are or they aren't. But the biggest benefit I took from the program is that the teacher, Derek Mather, I don't know if you remember Derek Mather, but he brought in, each week, he brought in a successful entrepreneur. And that, to me, is what really got everything firing in your mind. And he brought in a fellow who started a Russian cruise line right after the curtain had come down, and you could actually, and it was fascinating to hear, like, where do you come up with an idea of creating a cruise line in Russia? And the guy was from Utah, right? And so I think from
They don't do that there.
From a university perspective, I think it's fantastic to have a successful entrepreneur come in and say, here's how I screwed up, here's how I made it, because it really gets it firing in your brain as to how to be an entrepreneur and you know, thinking outside of your normal world and outside of what's in Alberta and so on.
There's a lady up there who's been very patient with her question. Oh. Okay.
My name is Bud Norris. I'm a 20-time serial entrepreneur. That's how I made my living for 40 years. And I want to thank you, gentlemen, for expanding the focus of this talk, because we've gone from diversification, which is, I believe, a longer-term wish list that is going to take a lot of money and a lot of entrepreneurs and a lot of energy to culminate in anything that represents an improvement in the Alberta economy. Then you've touched on entrepreneurship, which I am, and proud of it, and I believe that most of the things that have been said are true. I think there's been some exaggerations. I'm a guy that's lived it for 40 years, so I know how to do this thing. And the third thing, which to me is the most important, because like my shiny-headed friend down here, I have children and grandchildren here that need to have jobs. But nothing that I have heard today talks about how next week or next month we can have more jobs. Now, I think an entrepreneur, I have some of those solutions, okay? And mostly, it does not include government grants. In 40 years, I've never had a government grant. So I would welcome some challenges to that and offline, because those ideas would take up more time, and my dear friend here, Chrissy, would be poking me with her elbow to pass the mic and move on. So having said that, I will do so.
You know, I'm working with a number of provincial and federal organizations that do fund companies, and I would agree with you that a grant is probably the lousiest way to support a company, because if you give somebody something for free, they don't value it the way they would if there was either an equity or a debt participation in what you're doing. I mean, it's that simple. In economics, anything that's underpriced is overconsumed. It's that simple. So I would agree with you. Grants are not necessary, but I would say that the way our system is rigged, and in part it is because so many sectors are dominated by relatively large companies that are sort of in a quasi-monopolistic competition environment, that sometimes makes it hard for a good idea to get to the front. So having government participation in the form of commercialization capital, in my mind, particularly in capital-intensive industries, is almost a necessity. If it doesn't require a lot of cash and you can self-fund, that's ideal, right? And I'm working with one or two companies where that is the case. But if you're up against the fact that either you get the 30 million or you don't, and if you do, the company can build its commercial plan, and if you don't, then it will go down, that's a lot tougher. And again, it comes down to scale, right?
And just follow on from that also is that when I see companies, when they come to us to want to raise money, and maybe I'm wrong in observing this, but when I see companies had a lot of grants, and part of their business plan is also getting grants going forward, I become really shy about investing in those companies, because to me it almost tells me, well, this wouldn't survive on its own as a regular business, and it's reliant on grants, and I don't want to fund anything that's reliant on government grants or grants of any sort to make a business case out of it. So, and I recognize companies do, a lot of the grants do great things to help companies get started up and get going, but anytime I see a company that's relying on grants all the way through, then I become very shy about investing in those companies.
I think the matching stuff is good. You know, I don't think it's all bad in the grants, but when you there's some traction and you get an IRAP grant for technology and you're already producing and you got other stuff, and so, but I understand the points you're both making as well.
The thing that bugs me is when someone applies for a grant and there's a big company behind it that you sort of say, look, if you're a partner with this company because what they're making is important to your business, why the hell are you asking for a government grant? It doesn't make any sense to me.
But to answer the thing about jobs is I think we all own it, and that's something we have to own individually. Look to your left, look to your right. How can I create a new revenue stream? I don't really like the term job, but you know, can I hire a 16-year-old kid to shovel my driveway? Can I hire someone to come in and move stuff rather than me do it directly? I mean, I think we all owe it to ourselves. And I think in Canada, all too much, there's been this idea of this job sticking out there as though it's a big apple on a tree. And I think we all owe it to ourselves to say, how can I create a new stream of income? How can I perhaps hire someone or have someone help me for hire, or give someone a different skill set that they can get ahead? And I think if everyone in the room thinks about that day to day, I think it's going to grow exponentially.
You know, what I've noticed, I'm dealing with a couple of family-owned corporations, and the idea there is that, well, they are family organizations. The employees, and they have a couple of hundred each, are sort of part of the extended family, right? And they don't want to lay them off. And those companies can get very creative in terms of how to work with you along the following lines. Okay, you need this stuff built, we'll build it for you. And we'll give you our margin, we'll do it at cost or sometimes even below. But in return, I want, you know, when this thing is successful, I want $10 worth of business for every buck I put in. You wouldn't see that in a lot of the big companies. When times are down, they lay people off. When times are good, to hire them back. And sometimes they're wondering why they can't find the people they need. The family-owned corporations are a little different. And I must say, I admire that kind of attitude a lot more than just, the sort of Darwinian stuff that goes on in the large companies.
But the revenue streams are a good idea. Like you look at the sharing economy, if people don't, you look at Airbnb and Whirlpool, that's just thinking, like continuing to think what are the ideas as opposed to, oh, I'm gonna go get a job, or how Uber did it. Like these are great. I know they're easy to point to now because they're there and they're like, oh, I wish I thought of it. But that's the line of thinking that you have to pursue. So I agree with what you're saying there, Mick.
And just
We had another one up.
last, to answer your question on job and so on, and there's an MLA in the audience here, I understand, is that what I've heard from the Alberta government is that we need to diversify. And my question is, into what? And just to say we need to diversify, that's just so hollow. But what are we going to diversify into? And that's the more important question, and I haven't heard any of those answers. I don't know if there is an answer, but I just think it's wrong to say that without having that also.
Really? That seems. I thought that's enough of a roadmap for people to own it yourself, right? Like realize that, like Norway or whatever else, you got oil and gas, you got energy, and this is what happens. This is the cycle. You got to diversify. It's pretty instructive. Like to me, that means okay. Then all the actors have to now take that mantra and make it more crystal clear. Is government going to do something? Are other people going to do something? Are we going to leverage technology? That type of thing. So. I don't know. I'm just reacting to what you said. I feel like it's.
You can't create something on top of a non-economic base. That's where economies of agglomeration come in. You have to have a cluster of people. You have to have the brains to work with. Brains attract other brains, and businesses that work with those brains attract other businesses, and we don't have that yet.
No, but that's sorry to interrupt, but I do a lot of work at the Toronto Regional Board of Trade, and we have had like Porter come in and all the top Harvard cluster strategy guys come in, and people don't have it. But we're working on a healthcare cluster, an aerospace cluster. We're taking Pearson Airport and saying, look at the amount of jobs here. There's billions of dollars in economics. How do we build this out? And so all I'm saying is, if Notley says that in her speech, it's not rocket science, but clearly diversification is not like it's just going to be easy. You got to own it and get in there and build the clusters, right?
But as Dave was saying, you got 6 million people in Toronto. Okay, we got 4 people between Calgary and Edmonton, and half the time we're beating up on each other.
That I can't opine on, so I don't know, sorry.
Okay, let's move on.
Yeah.
Hi, I'm Christina, and I represent a formal angel group, as well as I sit on the advisory board, and I'm a founding mentor for a group called Venture Mentoring Services out of the U of A alumni.
Cool.
So I spend the majority of my time talking to young entrepreneurs, coaching them, mentoring them, and hearing what some of their major roadblocks are. And we have a lot of very eager and energetic young people in this province that are having difficulties finding jobs. They want to make a difference in the world. They want to be self-sufficient. And what they can't find is seed capital. So the gentleman, Ungad, you mentioned that, there's lots of things that people, early stage capital can be obtained through shred credits or things like that. But to get those things, you have to actually spend money to get them. I'm talking about early stage companies or entrepreneurs who can't even get the seed capital to see if their idea can even be brought into some kind of beta, at least, to be tested with the market. I haven't heard any conversation around how we as a province can help those types of entrepreneurs, because I think we need to remember that every large company we have in our province started off as a small business, as an early stage company at some point, and they all had to get some capital from somewhere. And I think we're missing out on the boat with those young people.
Right. Yeah, no, I don't for a minute think that shouldn't be part of the equation or the plan. The earlier comments were really around, what role and who's going to do that part of it for us, and looking at the banks and the pension funds and the exchange and the venture exchange and scale companies. The comment was made in that context, where can we get to the jobs the fastest as a country? And that's what the sort of the roundtable discussion is. It's not to say that everybody gets their $150,000 from their rich uncle, or everybody can reverse mortgage their parents' house and get $150,000. Like, I'm not suggesting that. So I agree with you, and I think that's got to be part of what the plan is, to look at creative ways to get access to that.
Can we get the innovation continuum put back up for a second, that slide that Russ had?
You know, crowdfunding came out of a social network in Silicon Valley. And it was basically throwing bread on the water. I'm going to develop an app, a t-shirt, you'll get a free product, give us the money. It took off. And at one point, the SEC got wind of it, the Securities Exchange Commission. And Obama, credit to him, stepped in and said, no, I think we like this just the way it is. But 5 years later, and I don't know if any of you have seen this, the SEC has rolled out a 475-page document to regulate equity crowdfunding. So the bait and switch to the folks that were taking this retail charity was, gee, would you like equity? Yeah, sure. All right, the trade-off is regulation. Now, would somebody explain to me what's happening in Canada with crowdfunding? Because in Silicon Valley, when this SEC reg came out, California, Silicon Valley, California said, we don't want any part of it. And they're not playing because Kickstarter and Indiegogo and others are working just fine.
Right.
So what are we doing in Canada to answer her question, the bottom of the food chain?
To start with, crowdfunding has no borders. Your investors could come from Russia, China, United States.
Absolutely.
So if I bought a drone the other day and I'm not an American, so I think there's no better time in history for a person to get seed capital for their business because you got access to investors from around the world. Indiegogo, like you mentioned, is exactly right. So,
But more directed to home, and by the way, thanks for doing that. I mean, thanks for being an entrepreneur and mentoring and everything else you do. I think if you look at this continuum here, there's, first of all, family and friends and fools, as we call it, exemption. If you go through those boxes, there's actually more boxes now. I don't know if we've got family offices in there or not. I can't see it, but I think all too often what happens is that people get caught up and they say no. And to my way of thinking, it's kind of a continuum flow chart. No, why not? Get the input, readjust, rejig, go to the next thing. Like when I came to Calgary to be 3 years, it was 3 years Thanksgiving, I had no idea the proliferation of family offices. There are tremendous number of family offices in Calgary. So I think you just got to keep going, and part of that is that there is sort of a law of the jungle here, for lack of a better term, and there is the fittest are going to survive. And it's amazing, like I don't know if you know restaurateurs. Most restaurateurs who I know have been bankrupt once, twice, 3 times, and then they make fortunes on the 4th time. So that continuum, I think, is important to keep going. Right?
Yeah,
through
anyway,
that continuum.
can we, before we leave the subject of crowdfunding, I want to introduce somebody in the audience here because he should have been on this panel too, and it's Richard Stedelweiser, whose title is Executive Director, Access to Capital in the Economic Development Department. Now, between Richard and Dave, who have worked on this crowdfunding in Alberta, explain to me how it's going to work. I mean, I'm just asking a dumb question. I mean, is there crowdfunding money for this startup level?
yes.
So how does...
Alberta, we have a crowdfunding site, Alberta Booster, but there, if you Google crowdfunding sites, you'll find 35, 40 of them.
And is it equity crowdfunding, or is...
Some of it will be a contribution, so like the drone I bought, I get a drone, except I get an early beta version of it, but they get to develop all the stuff. So that Indiegogo would be primarily that kind of thing. But there's crowd lending as well. We have Alberta Lender, which would be the crowd lending, and so there's Albertans involved in that. But there's lending sites all over the world. You can get money from England.
UK is the biggest.
Here in Alberta. So there isn't a border.
So I guess what one of the things we're trying to do here is provide a point of contact, a guide, where one can be led through this continuum.
Right.
Like, this lady probably doesn't know how to access your seat.
I know, but what I'm telling you is the entrepreneurs that I'm talking to, they don't know.
So we all have to guide them, eh?
And figure out for them how to explain it to them and make it relevant and easy to access for them.
Right.
Not for me.
And so, I mean, I'm not here to sell ATB. We have an entrepreneurship center, right? It's sitting at Gateway in White Mud, and they would be happy to help anyone.
Thank you. You're a sponsor for our Angel Group, and we hold our events at your location in your entrepreneurs.
All right. What a bank. Holy cow. I can hardly believe it.
I didn't get our list of sponsorships in the province.
Okay, we have another speaker.
I'll just comment a little bit. Thank you for that introduction, Russ. And of course, I too, Richard Stellweiser, have worked a lot with ATB and Business Development Bank of Canada in the last year. There's been a very good partnership there to try to look at some gaps, how they might fill. Back to the question about the Alberta Securities Commission, and I don't want to speak for them because, of course, I'm not the Alberta Securities Commission. I'm within the department. They have worked hard on crowdfunding. So initially, they created a new type of crowdfunding, which is just for startup companies, and it did have a lifetime maximum amount you could raise through it. They had some pretty positive comments from both security dealers as well as individuals, as well as companies. And so they have, after the consultation period, that has been passed, that has been brought into force. However, they also felt they should have a crowdfunding without a lifetime guarantee, without a lifetime maximum. And so that went through consultation not very long ago now. And the Alberta Securities Commission is reviewing those comments. They are available on their website. You can read what came in. And the Alberta Securities Commission is extremely independent of government to an extent. And therefore, they will be deciding how to go forward with that. Again, what we heard earlier in the day about balancing risks to balancing the benefits and the needs of Albertans to have that investment vehicle, as well as for companies to raise capital. So I do think that equity crowdfunding already is available to some extent through the normal exemptions that were available on the market. They were enhanced with the startup exemption that has been brought through. And thirdly, they will be potentially expanded again with a full crowdfunding option without a lifetime maximum for the enterprise. And we do welcome you to see that site. I think today we heard, to myself, I thought it was interesting, we heard about the venture capital, sometimes not so much with the independent dealers, the working together relationships. I think what I also thought was very interesting from almost everybody is you talked a lot about working together and how the system all has to work. And I think that's what, you know, as we develop the investor tax credit, the investment tax credit as well, all these pieces are coming together more in Alberta than they were, as well as I do think we have better deal flow than we would have had some years ago. It is that handoff between family and angels, angels and venture, angels and angel groups, venture and private dealers. I think one of the things we haven't heard is some of the slides talked about what government might do to keep private, to help the private dealer sector and that part. But what is it that's making the market let it happen? Why are we seeing less? Yes, you're saying the big banks have some of it. Is there something else in the market that is that
Well,
the
yeah,
market
I mean, there's a
themselves
number
can
of
do?
systemic reasons. One is the aging population in Canada. So as you know, we've reached that tipping point, and there's more people over the age of 65 than there's ever been. And so I've seen it myself in terms of asking investors for money. When people get into that, seems 59 to 60 years of age, they stop making venture investments. They sure as heck aren't going to do crowdfunding, and they're looking at preserving their capital, which tends to take them into the Canadian bank stocks and other things that are at a 3.5% dividend yield plus, and they stay in those. And so we have to find a way to channel that money that's locked up in the system into riskier ventures and where it's needed with young entrepreneurs. But that's a real challenge with the aging Canadian population.
Just one thing on the overview for crowdfunding is very helpful. It's a bit of a web across the country, unfortunately, where we have some provinces that are way ahead, some provinces that are way behind. Just so people know, very simply, not technically, just so you know what all these securities commissions are really grappling with and why it's 473 pages in the SEC and I don't know how many pages in all the various provinces here, is that fundamentally they're looking at investor protection. So I think as a society, we also have to think to ourselves, okay, so I can go buy lottery tickets. The guy doesn't stop me if I spend $1,000. I can go to the casino. Doesn't stop me, $5,000. Here you've got something called the World Wide Web that you can go and see all the, whatever disclosure you want. You can go to a social media site and go, you know, I was going to hire that carpenter. Let me go to HomeStars and see his rating. So same thing when you're going to, you know, Airbnb or whatever. How do you know the guy at Uber is not a murderer and he's going to pick you up? Because he's got 7,000 rides and they've. So we're already relying on that. So, you know, while the commissions and others are spending a lot of time on protecting you with 473 pages before you can put your maximum in, which is $2,000 per year or whatever cap they allow you to do, you know, that's what they're working on. So I just wanted people to know that it's protecting the risk capital from fraud, getting burned, whatever. And I'm being relatively neutral about it. There's some good things about that, and there's some bad things about that. But just in case you were wondering, it ain't rocket science. I mean, you've got an internet, you've got people, put a product, you want to buy it, you should be able to buy it potentially. So I'm just dumbing it down quite a bit, but just I felt like saying that.
And again, part of this may be cultural. You go to the Bay Area, the culture is one of boundless optimism. And maybe it's because it is successful. But when you have the original crowdfunding emerge, the retail charity on the social network, people are prepared to take those losses or hope for the best. So that's not something that ought to be snuffed out. And California refused to let that happen. And in our case, it's, you know, a matter of cultural encouragement or mobilization that's maybe part of the agenda here.
The one thing you absolutely can't lose sight of, because I actually sit on the Ontario Securities Commission Exempt Market Advisory Committee, which oversaw crowdfunding when it was brought in, is that the one thing you can't overlook is you're taking the least sophisticated investors on the planet and you're marrying them with an investment that has absolutely no disclosure, and there are no background checks, no due diligence, nothing. And so when you marry those two together, there are going to be problems. 100% guaranteed.
18 years old and
perhaps,
they can read, right?
Perhaps this is a matter of semantics. I mean, there ought to be two different names for this thing. The original crowdfunding was retail charity in the social network, period.
It wasn't equity, it wasn't investing.
And then along comes your equity crowdfunding, which is bottom of the food chain securities investment.
That's right, yeah.
So you've created an accreditation process, a threshold, the amount below which investors should be allowed to lose.
And the discontinuance here is that in the IROC world, which I exist, if I buy Granny $3,000 worth of TD stock and she's 85 years old, IROC is all over me. Why are you doing that? Huh. And yet Granny can go buy $3,000 worth of crowdfunded moose pasture sold to her from a slickster who just moved up here from Oklahoma, and there's no regulation. And that's where I'm saying there's a complete imbalance here in terms of how you're letting people into the equity capital markets. And I know everybody says, well, it's only $1,000 or $1,500 or $2,000 or $2,500, and you can lose that much at the casino, you can buy lottery tickets, et cetera. Except when that person comes up and does 10 crowdfunded vehicles and raises $1.5 million and 10 of them and is gone with a $15 million bucks, and then who do you go after? Who do you hang your hat on? And that's the problem, is what everybody's trying to do. There's all the other problems. There's the AML, the anti-money laundering. Because when this first came out, this is going to be done through portals. And you're going to have portals where the person put the money in. The portal was going to be the gatekeeper. And I said, well, how do you pay for your crowdfunded stock? Well, you can use your credit card. And I go, well, has anybody talked to the RCMP or the anti-money laundering guys about this? Because this is going to be problematic, because this is going to be used to launder cash. Right? So there's all these different, I know it's easy to say, let's just open it up. There's all these different things. In the U.S., they do have crowdfunding, but it's for accredited investors.
But I agree with you, and that's why it's 473 pages. Yeah. But at the end of the day, just to be provocative for people to think about it, it's a product, and you're a consumer, and you're buying it from some sort of storefront. You might have a broker, you might not have a broker. So there's something in that in the future, as everything is getting disintermediated. I don't need a travel agent. I don't know how many of you go to a travel agent anymore. I don't really think I need the LCBO in Ontario if I want to go directly to Hillebrand Wines, and I'm comfortable buying it from them, but I'm not allowed. So all these things are, you know, there's something to think about.
And when do
right?
we put it back to the individual? Ultimately, it's the individual's responsibility to be more financially literate in the internet age. And I'm a big believer in a libertarian philosophy of educate yourself, make your own decisions. People are going to buy it anyway. Yes, we need regulation, but ultimately, I'd like to think that the individual has enough intelligence to buy what they want to buy.
But we have the best crowdfunding platform in the world, and it's called the TSX Venture Exchange. And my point on this, from sitting on the OSC and speaking publicly on it, is that let's go and work with the TSX Venture Exchange, because we know we've got a regulated entity that has got the best reputation in the world, and let's make that our crowdfunding exchange in Canada and tailor the regulations so that you can allow that to happen. Because as Onget said, it's only 40 grand to get on there, right? And you can probably bring that down, and you can have the best crowdfunding
Now he's my best
platform
friend
in the world.
But
So-
I know. One last sentence. All I would say is, why either or, and why not both? That's all I have to
Well, here's a problem though. When they talk about portal, I scratch my head. I mean, you've got a retail level here where we're eliminating the intermediary, the agents, the independent investment dealers. I mean, for God's sake, you need somebody to vet at that level if they're vetting at a higher level. So there's nothing wrong with extending the role of the independent investment dealers down to equity crowdfunding.
Bingo, but then it's up to the dealers to financially innovate, to integrate the systems and make it happen. Consumers go where the best product is at the cheapest price. So innovation has to happen on all levels, and when you don't innovate, someone finds a way to buy it quicker, cheaper, faster.
And so I wrote the dealer exemption 3 years ago, and to the credit of the Alberta Securities Commission, it took 3 years, and we got to push through. So there's new exemption in Canada now. If you're a public company and you're listed on a recognized exchange in Canada, and you go through an intermediary such as an IROC dealer, then you don't have to issue a prospectus to issue more shares in Canada. So anybody can participate. A retail investor can buy $1,000 worth of stock if it's a public company on, as Onget said, there's only one exchange in Canada, TSX Venture Exchange, or two, TSX. And so what that was doing, it was broadening the market so that smaller companies can get access to capital cheaper in a regulated environment. And that was my hope, is that that would open up the capital markets even more so that people could get cash. It just seems problematic when you're dealing with a completely unregulated world and you're allowing them to access the investing public. It was my concern.
Exactly.
So we have time for one more question from
Sure.
the audience. Hussein, do you have one?
Absolutely. My question, if we go back 1985, Alberta GDP at the time only 36 billions, and the oil and gas, basically, the share of the oil and gas around 36%. Last year, the GDP 333 billions, and the oil and gas basically only, 16%? So we are diversified. My point's in here. Why we come up with the concept of diversification only when the oil and gas is downturn? And is it supposed to be something we work on it all the time? The second point I want to make in here, are we over-regulated or under-regulated?
Well, you know what? I think that we do diversify when the price of oil and gas is high. That's how you end up with the WestJets of the world. That's how you end up with all these various different companies, how you end up with Boardwalk Equities, how you end up with various different successful stories out of what it is, because, and it comes back to the cycle of capital. Generally, I don't believe that people invest their earned wages in venture capital. They invest capital. So the more success you had in the oil and gas industry, the more people you had walking around with 100 grand in their pocket and said, hey, I'll throw 20 grand at that startup company. I'll throw 10 grand at WestJet, when Clive Bettle started WestJet, and we got a group of investors to start up. How did you get an airline in Alberta? It's because there was tons of capital available, and people said, I will take a risk. I will put money into biotech. I'll do this. So I do think the reason why the economy is so diversified now is because at the top of the market, when people were overflowing with cash, they were diversifying. It's when Clay Riddell puts $100 million into the university or the hospital, that creates diversification and creates centers of excellence. And they were taking that large ass from the oil and gas patch and pouring it back in. So I disagree. I think that we were diversifying the economy when oil was up high. When oil is down low, it becomes only more apparent how reliant we were on that oil to diversify our economy. And had we not done that, we'd be in even more serious trouble right now than what we are. And on the regulation, over or under regulated, I don't think we're over regulated. I think that within the regulations, the requirements are just too onerous. When you have a CPC and you start up and you raise $300,000, you have to go get an audit on a $300,000 user. So you have to go pay $7,000 or $10,000 to audit the fact that you just raised 300 grand.
Just be a bank statement.
It's crazy. And when you send that prospectus out, when I started in the business, CPC prospectuses were 15 pages. Now they're 100, 120 pages. To say
the cost of capital for a capital pool company, and I've done one last year, is over 33%. So that's expensive for to get listed in terms of, I'm saying not necessarily the exchange fees, but the accountants, the lawyers, everybody else. That's largely untenable unless you're very confident you're going to go to the next level and acquire a business that can support that cost of capital.
Dave heard that 33%. He's going back and raising rates tonight, right?
It's only 33. But to answer your question, I think we are overregulated. And with all due respect to Lynn, and Lynn is an ex-investment banker. She's as smart as anyone in the street. And Alberta has a history of financial innovation, like Darren helped put together the Capital Pool Company, which is really one of the last innovative things. And everybody should look at that. That answered the question, why would I go into an old, crappy mining shell when I can create a brand new company in Alberta and get the same effect? And that propelled the consolidation of the exchanges. But I do think, I'm old enough as a dinosaur. I remember talking to a paralegal in Vancouver. A guy showed up from Texas on Monday and said, if you have my prospectus receipted by the following Monday, you get a fur coat. And she got it. So how did we go from 1 week to receiving a prospectus to arguably now 2 to 3 months? I want to know why. On a junior company. I'm talking to junior company, not talking to senior company. I'm talking to junior company with essentially their only asset is cash, or their only asset is a few oil and gas leases in Saskatchewan or Alberta.
And I encourage everybody to read the risk disclosure on these prospectuses of CPCs even now, because everything you can possibly imagine is covered in the risk disclosure. It's things like the price of oil might go up, the price of oil might go down. And I've joked and I said, the only thing you don't disclose in there is a risk right now is the sun might not come up tomorrow. That's the only thing that's missed in the risk disclosure. And these risk disclosures go on for pages and pages and pages now. And it's for what? It's just, that's the overregulation part. It's killing.
Wow. What a note to end on. I wanted to thank you all for sharing your wisdom with us. And I wanted to ask you if there's any last words of wisdom that you have that you would like to share before we wrap up. Russell?
Well, the takeaway here
Yes.
is curriculum development at Athabasca. And you've certainly got my support to work on this from the full range of financial literacy to anybody, to educating the cabinet and everything in between. So we can develop a range of product, dare I call it that. It's essentially our curriculum that can be designed and packaged for that full range.
Thank you.
Get financially literate. Never been a better time to be an entrepreneur. Make the bridges, use the tools, get out there and make it happen.
Thank you.
And define what success and failure is as you do that.
Darren?
Call your MLA, call your MP, and tell them you don't want Alberta run out of Ontario. And you want independent brokerage firms, you want independent banks, you want independent regulation, and you want it here in Alberta because we know what's best for Alberta.
I've got nothing more to add. That's great. Over next.
No.
Yeah, I think when you hear people with solutions, you should either decide to support them or not. But Alberta's turned into a bunch of complainers. So when people have solutions and when the politicians are trying something, we need to figure out how to support it as opposed to tearing everything apart.
Yeah, as I said earlier, I really feel that to stay competitive, and you can argue over how much diversification is possible, we need to fund a bunch of guys who have better ideas than the ones that are running around right now. We have to bring down the cost of what we do in this province. And by a lot, not just by cost cutting, but by changing technologies.
Well, thank you all very, very much for all of your words, and thank you all for all of your questions and stimulating discussion. As I mentioned at the outset, this is the first event in our Future of Learning series. Next month, we're also hosting 2 events in Toronto in conjunction with the NHL Hall of Fame induction ceremony, and we're hoping to host an event very similar to this one in Calgary in the new year. And as Russell mentioned, we're also developing course content at the undergraduate level using the securities course, as well as curriculum at the graduate level on expanding our new venture development and how we might better move companies through IPO and so on. We want to keep this topic front and center. And as you've seen with the advice and the ideas and the connections in the space that were shared today, consider being involved. We'd love to hear more from you. So we believe that Alberta can become the preferred jurisdiction in North America to take a company public. And this could be our new Alberta advantage, just saying. So thank you once again for being here on this rainy day, and I really am very thankful for your participation. Good evening.